Good morning and welcome to our third and final day of Small Business Finance Basics, QuickBooks, and Beyond with Ken Boyd right here on Creative Live. This is Chris Jennings.
And this is Evelyn Danford, also known as Evie.
Thank you, Chris. And we're going to be your hosts for this final day of Small Business Finance Basics. We have learned quite a bit over the last 2 days, wouldn't you say?
Yeah, it's been a jam-packed first 2 days of this workshop. We've covered a lot of the terminology, a lot of the formulas.
Yeah. We
really got down into the nitty-gritty of how all of this works. And what I'm really excited about for day 3 is taking all this information and applying it to our businesses, the businesses that we've started here in the studio audience, as well as everyone online. Now that you have these tools, you can apply them directly to what you're doing in your life.
And that's really when it starts to get exciting, because you see it go into play and you see really how we can use this to the best of our ability.
Yeah, it's kind of all hypothetical in theory, but now you can see how this can improve your business and make it, more profitable and have that long-term stability that you're looking for.
Absolutely, absolutely. Well, we are all excited to get started, but before we do, we're going to just take a couple minutes, 5-10 minutes, to test our audio and video levels, make sure all of you out there can see us and hear us all right. So don't forget to jump into those chat rooms. Let us know everything's working for you. And also let us know where you're joining us from. We do like to give you those shout outs when possible.
Absolutely. Yeah, I have the chat room right here in my hand. So I am going to be checking in with you guys throughout the day. So do jump in and start telling us where you're from and what you're looking forward to in the workshop today.
Yeah.
So I do want to remind all of you out there who are watching online, you've seen over the past 2 days that we have a great studio audience here in our studio in San Francisco. And if you were wondering how you can be a part of it, that is very much possible. We've made it super easy for you guys. If you are interested in being in our studio audience and getting that different experience, it's great watching online, but it's really special to be here in person as well, to interact with all of us and feel that energy. It's very easy for you to do. We've set up a website for you. If you go to creativelive.com/front row, you'll see all the information there, how you can apply to be a student in our workshops, either here in San Francisco or our studio in Seattle. So go check it out.
Absolutely. You can simply take a look at our calendar, find a course that is of interest to you, and go ahead and apply.
Absolutely. Yeah, so we have a great studio audience here for the past 2 days. In case you have missed it, we are going to have them reintroduce themselves to all of you out there. So why don't we do that right now? Why don't you tell everyone your name, where you're from, and remind them why you're here and what you've been enjoying about the course. Go ahead.
Hi, I'm Candace Betty from Huntington Beach. I'm here because I own 2 small businesses, one organic skincare, one photography, and I'm looking to make them profitable in the long term and get my numbers down pat.
Terrific.
Great, thanks.
Hi, my name is Josh. I'm from San Francisco, and I'm hoping to learn how to better manage some rental properties.
Great. Thank you.
Hi, my name is Jackie O. I live in San Francisco, and I own a textile and batik boutique. And I'm just interested in learning everything there is to know about QuickBooks so I can use it better for my businesses.
Thank you.
Hi, I'm Christine Chagru, and I'm from San Francisco, and I'm a freelance producer of film and video, and also looking to form a production company with other individuals. So learning the accounting basics and QuickBooks is really useful.
Absolutely.
Hi, good morning. My name's Renee. I'm from Sacramento, and I'm here because we're starting up a new business and want to get a good foundation for that.
Great. Thank you.
Wonderful.
And how
Great
about
to hear
online?
from you. Yeah, we have a lot of people who are coming back to the chat rooms who've been there the past few days. So welcome to Dick Horner, who's joining us from Germany. We've got M Cut, we've got Rogers Pro Photo, and also today we have Cindy joining us from Woodstock, Illinois. So welcome everyone, and we're looking forward to day 3.
Absolutely. Well, Chris and I were discussing this morning, just talking about the student experience and what it's like for what they're expecting, and then once they get here, what they actually experience as students here at Creative Live. And we have one of our students, Christine, has a unique perspective, being that she comes from a production background. So we thought we'd bring Christine on up here and talk to us a little bit about your experience.
Come on up, Christine.
Come up here, Christine. Welcome.
Hi, thanks.
And we were talking this morning, and we thought we would share with our audience a little bit more about who you are and what your background is.
Okay. Well, believe it or not, originally I was a accounting major.
Well, we didn't know that.
I know. And it's great to get the basics again and come here and see that. But yes, after a year of accounting, I decided that wasn't for me.
Yeah.
And got into marketing, which turned into advertising and photography and now film production. And I've never done live, so it's really fun to be here and see what it's like.
Right.
And it's
quite impressive.
Yeah, so, I mean, give everyone a little bit of a sense of what it's like to be a student here in person. You know, is this what you expected, having that production background, sort of seeing everything that goes on behind the scenes here at Creative Live? How's that experience been for you?
It's been really enjoyable and relaxing,
Yeah.
and a very professional crew and host and teacher.
Oh, thank you.
And it's nice to just sit and watch it for a change,
What-
as opposed to doing it.
What were you expecting coming into Creative Live? Did you have any images in your head of what this experience would be like?
I saw chairs, but then when I saw couches,
Oh, couches were a thrill. Okay, good. I'm glad the couches made you happy. Is there anything that you have as a background, with this background in production, that you thought might be different, or anything that surprised you?
Overall, just how smooth it all is, and you know, I'm sure you've been doing it for a while now, so you've got it down. But it's just a very comfortable experience.
We
and
didn't pay
everybody's-
Christine to answer these questions so nicely.
Honest opinion, we appreciate it.
Yeah, no, it's been great, and wonderful food too.
Oh, great, great. Well, how about within the finance and business? Was there any area of your business that you specifically needed this for, and how do you see yourself growing now that you have this education from Ken? under your belt?
Well, I am, as I said, I've been doing kind of my own thing and sort of hobbling through with that. And now that I'm looking to join with other people, it's nice to see how we should be forming the business. And then I'm sure I'll take on the responsibility of the finances in that group too. So it's been wonderful to get a refresher, really.
Definitely.
Everything that I need to pay attention to.
Especially that segment we went over yesterday when we were talking about partnerships and exactly the smart way to go into each of those. I imagine that was an effective section for you.
It definitely was.
Yeah.
Because we've started with a little bit of paperwork on what we expect, just with who puts what money in and how you get that out, but to pay attention now to the roles of people and the values of them is really useful.
Now, you work primarily as a freelance producer. How have you seen yourself grow? And is there anything that you've learned in here that you've thought, man, if I knew that, you know, how
I could
5
go
years
back in
ago,
time
if
if
I
I
could
knew that
just do.
then.
Well, yeah, definitely the accounting.
Exactly.
Yeah, Candace and I were talking about that, how we'd maybe look at how we have been doing things and do things differently, and why perhaps now QuickBooks will work even better for us.
Yeah, no, that's great to
Definitely.
hear. I think we always say, like, now is the time to take this on. If you have been out there and you have been overwhelmed, I know a lot of people are intimidated by this subject. I think that you're a great example of how you can get into it, you can overcome it, and today is the time to start improving your workflow and getting your finances in order.
Yeah.
Great.
I agree.
Well, one of the other things that you've been so supportive of us just in these questions. I didn't expect we'd have such a glowing review.
Yeah.
I mean, we love it here, but it's always nice to hear. And so many of you online as well. We have such a great support system here at Creative Live, from right here in the studio to everyone all over the world.
Yeah.
And we're really grateful for that. And one of the things that we've been talking about a lot lately, because we are genuinely so excited to have been nominated for the Crunchies, which, if you're not familiar with the Crunchies, this is quite an honor to be nominated. In the area we were nominated in is Best Educational Startup.
Yeah, and we're really proud of this nomination. There are a lot of other wonderful companies out there doing things in the educational space, but we're really proud of our efforts here. When we get these glowing reviews from our students, from everyone online, it means a lot to us. So if you have been enjoying what we're doing here at Creative Live, we would appreciate a vote for us as the best educational startup for the Crunchies, TechCrunch's annual award, to help give some recognition to a lot of companies that are doing great things in the space and startups that are making a difference, which we feel that Creative Live is.
I think we are, and if you'd like to give us that support, you can vote for us at the URL on your screen. You can vote once a day up until January 26th, so thank you for that support. And thank you, Christine, for coming on and joining us. It's such a pleasure to have you here, and we love hearing your perspective as well.
I've loved it. Thanks.
Absolutely.
Thanks a lot.
We are going to do just a few minutes. I'm just going to take you on a quick tutorial of how to watch today's class, how to ask questions in chat, and also how to purchase anytime access. Now, if you'll notice, at the top of the screen is a green Watch Now button. You'll find this Watch Now button at the top of this screen or any page of the Creative Live website. When you click on this button, this is what you'll select to watch any course that you'd like. Now, a menu will appear, and this is where you'll select which course you'd like in the various channels. Additionally, at the bottom of this page, this is where you'll find the Buy button. Now, this is where you can purchase anytime access to the course. Also at the bottom of the page is the green Chat Live with Class Participants button. You can click on this button in order to chat with other Creative Live community members. Now, what's great about Creative Live is that we truly are a global online community. So you can discuss what's going on in the course, you can discuss anything you'd like, and you can also post questions for Ken, our instructor, by clicking on this button right here. Now, when you click on the button, a new window will appear with 3 tabs. Now I'm going to discuss each tab right here. The Creative Lounge is the first tab you might find, and this is for off-topic discussions. So in the lounge, this is where you can get to know your community members a little bit better. Your conversations don't need to be on topic. You can just have a nice little conversation there. The second tab is the Creative Live tab. Now this is for on-topic discussions. So anything that Ken or anyone in the class is discussing at that time, you can discuss right here. And the third and final tab is the Creative Cues tab. Now this is where you'll post all of the questions for Ken. Now we do ask that you only post questions here. Don't answer or discuss any questions if you'd like to do that. We do encourage you doing that, but just take it back over to the Creative Live tab. Also, there's no need to post your questions more than once. We do have a chat moderator, Alexa, working very hard behind the scenes, keeping track of all of your questions, so we will get to them as time allows. Now, this is Small Business Finance Basics, QuickBooks and Beyond with Ken Boyd right here on Creative Live. If you're new to Creative Live or you're not sure exactly how it works, what we basically do is try to reach as many people during the live broadcast for free. However, if you're not able to catch the entire course during the live broadcast, or it's a course that you simply think you're going to want to take a look at later on and have anytime access to, we also offer it for purchase at the cost of $149. However, if you purchase it right now during the live event, you can purchase it for the live discounted price of just $99. Now I'm going to take you over to the course page where you're watching the broadcast as well. You'll notice that there's a green enroll button. You can enroll for free, and when you enroll, you'll not only get email updates, but you'll also have access to all of the enrollment bonus materials. You can additionally purchase the course, this anytime access to the course, right here very easily as well. Now if you scroll down from here, you'll notice this is where you'll access the bonus materials that we mentioned. There's bonus materials both with enrollment and with purchase, and this is where you'll find them right here. And directly below that is where we have all of the course videos. Now you can download the course videos, or you can simply stream them directly from our website by clicking on that green watch button. And with that, I think we're about ready to introduce our instructor. He is a former CPA with over 29 years experience in education, accounting, and financial services. He is the author of Cost Accounting for Dummies and co-author of Accounting All-in-One for Dummies, both of which are available right now on Amazon and on his website. He's also the owner and instructor at St. Louis Test Prep, and a small business owner himself who professionally counsels other small business owners, providing them with feedback and guidance to reach their business goals. So with that, I'm going to go ahead and introduce Ken right up here on stage. Ken, thank you for joining us today.
Thanks. Thank you.
We have covered so much. It's amazing, and I know we have more to go, so I'm going to let you get right to it.
Okay.
Thank you.
Thank you. Thanks, everyone. What I'd like to start with is a really, really great site that is going to answer a question that I've been asked off and on throughout, which is, if I need more specific help, where can I turn? And this is the site that I'd like to suggest that you go to. It's called Intuit's ProAdvisor site, proadvisor.intuit.com. You can see in the corner there that you can put in your zip code and even a distance from your zip code, and you can come up with people who have passed a certification through QuickBooks as experts. And I can tell you, after looking at that designation myself, it is a lot of work to get the QuickBooks Pro Advisor designation. So what I'd like to do is just click in my zip code, and I'm going to say I'm willing to see somebody who's within 5 miles of where I live. Shout out to Kirkwood, Missouri, the 63122. So they give you a lot of great stuff here. Among other things, you'll see that this says advanced at the top. Not only is there one exam to become a QuickBooks Pro Advisor, there are actually multiple levels you can take. So they tell you, they have a rating down here. They tell you what level they're at in terms of passing the exams, not only with this advanced sort of flag at the top, but also over here they give you the certifications. This person, for example, has been QuickBooks certified for over 10 years. I don't know them. They handle QuickBooks Online. Enterprise is the most sort of souped up version of QuickBooks. So I've mentioned throughout the course that there are businesses that are running $10, $15 million in sale businesses on QuickBooks. That would be the QuickBooks Enterprise software. Also tells you how far they are from your house, phone and email, and you're given multiple suggestions here. This is within 5 miles of my house, and I've got 2, 4, there's probably 10 plus people listed here, and there's 3 more pages. So again, my reason for pulling this up is to let you guys have a resource if you want to talk to somebody who's a professional on QuickBooks. So it's a great resource. I'm going to now switch over to the slide for the first segment, which is called Income, Expenses, and Generating a Profit. Income, Expenses, and Generating a Profit. And I wasn't going to put this question up initially, but I think I will to kind of get us warmed up and get us starting to think about this topic. We've covered it a couple of times in different formats. Have you ever turned away business and why? So I'll ask the folks that are here, have you ever turned away business and why? To anyone? Yes. Jackie O immediately nodded her head. Yes.
I have turned away business. Most of the time I've turned it away because I either didn't think it was a right fit, whatever their needs were, I didn't think that it was my expertise, or I just didn't think that working with the client would be a positive experience for either one of us.
Perfect. Yeah. Not a fit. Maybe the person's difficult. Okay. Maybe their deadline is too tight, which is one I haven't mentioned yet. In my profession, most people who come to me for coaching or training on accounting are MBA students who are in crisis because they have a paper due Sunday or they have an exam next Wednesday and they're struggling and it's an emergency. It's not always possible for me to schedule time for them, number one, or enough time for them, number two. So maybe there's a time deadline that you can't meet. The hardest thing for me in turning away business was telling people that I didn't have time, because I used to move heaven and earth to get them the time, and for personal reasons I don't do that anymore. I'll make as much accommodation as I reasonably can, but there are periods of time where I don't take on work and I say no. That was really hard for me to do. So, not a fit, you don't do what you don't have an expertise in what they want, client's too difficult, time frame is too short, okay? That comment gets us starting to think about income, expenses, and generating a profit. And I've said it several times and it bears repeating. Successful business owners ask for fair compensation, ... And the end of that we couldn't fit on the slide is, not only do they ask for fair compensation, but they turn business away in certain circumstances. What I'm going to go through is the income statement formula one more time. How profitable should my business be? So that's the compared to what type of thing. Compared to what? Is my price high enough? I have a very good friend of mine who's a CPA, very successful. In fact, if I would have kept scrolling through the QuickBooks experts, I would have come across my friend. And one time I asked my friend, well, Joe, how do you figure out what to charge people? And without hesitation, he said, I charge people as much as I can possibly get away with. And then he laughed and he said, being serious, I really provide, and he does, a very high-end expertise. I'm very responsive. I've been in this business forever. I push the envelope on what I charge, and he does. I know he does because I've referred people to him. I had a CPA practice. It wasn't full-time, it was part-time, and I shut it down and I sold those clients to him. And I started getting calls from people who used to deal with me saying, wow, Joe handed me the invoice for my tax return and it about took my breath away. And I said, well, you remember that I told you that he charges more than I do. But it was fair. Don't get me wrong, it was fair compensation. And he had no hesitation. Now, I'll also bring up another comment on my friend Joe that relates to operating cash flow and how to better collect cash, because it's a good point, and since we're talking about Joe, I might as well mention it. His business was about 50% doing tax returns. He always handed the person the invoice when he handed them the tax return. Because once he does the tax return, and if the only business he did with that person was their tax return, when was he ever going to see him again? When was the next time he was going to see him, I should say? Next tax season. So there were situations where people would get the tax return mailed to them, and they wouldn't send him, they wouldn't pay him for months. Why? Because they don't need him again for a whole nother year. So he trained his staff that I want to meet with clients not only because I want to explain the return, which prevents problems later, that's coaching your clients. I also want to hand them the invoice so they'll pay me while I'm sitting there. Because otherwise, they don't need me for a whole nother year. Okay? Food for thought. One of the other things I'm going to do today, and I'm excited about this, is I put the table of contents for two of my books on this iPad. And what I'm going to be able to do as we roll through is when we get to certain topics, I'm going to go to the table of contents from the books and pull some of that content and use it in class. I wasn't sure if I was going to be able to get to it, but I am, and I'm kind of excited about it. So there'll be some added stuff from the books. Not that I'm trying to sell you books, I just have the content. Okay. We've talked about this till we're blue in the face, the income statement formula. So I'm hoping by now that when I go into QuickBooks later, you can envision we've got that reports page, and at the bottom we've got profit and loss and the balance sheet report under the reports menu. And so profit and loss report is this, right? Revenue or sales, we use the two terms interchangeably. Less expenses equals net income. Now, I could have put on the slide profit. Remember that net income and profit are the same thing for this course. Revenue and sales are the same thing for this course. So the next question is, how profitable should I be compared to what? Okay. First, the formula. Profit margin. Now, let's forget about the math for a minute. Forget about that and go to number 3 at the bottom before I do the math. It says, for every dollar I sell, I earn 15-cent profit. For creative people who are not mathy people, the way to remember profit margin may be number 3. Oh, for every dollar I sell, I earn a 15-cent profit. Now, let's talk about how the math works to get you to number 3. Let's look at number 2. We take profit, numerator of a fraction, and divide it by sales. So for example, on the board, if you sell a package of photos for $300 and you have a $45 profit, $45 profit divided by 300 sales gets you 15% profit. But I think for this audience, most of you are more comfortable with number 3. Okay? Some of that may be stuff we've gone over before, but now, this is new, and we're going into a new formula. And in fact, the formula that I'm going to go over, the break-even formula heading that you see there, is on the bonus material. And it's a great thing that you can use, and it's in yellow on the right-hand side of the chart here, and play around with. And we're going to do some playing around with it here in a minute. First of all, is my price high enough? The title of the slide, specifically, does my price cover all my costs and generate a reasonable profit, whatever reasonable means to you? Okay? Break-even formula. Does the price cover all of my costs? That's the first step. There's an example that I use in one of the books where I say, let's say you're considering going to a convention. I'm going to try to write a little neater today and slower. And you're going to have a booth at a convention. And the booth's going to cost you $2,000. And that's a fixed cost that's not going to change. You got to write a check for $2,000. The reason you're going to the convention is to sell a piece of software. So you're going to have a desk, a booth, with the software on the desk. And let's say the software costs $30 a unit. Now, a big thing in accounting that I preach is label numbers. Label numbers. Here's what I mean. That is dollars, not units. Okay? Later on, I'm going to do something with the number of units you sell. That number is dollars. It has a dollar sign by it. That may seem, well, why does that matter? When you start doing a formula that has both numbers, dollar amounts, and then units of product, you've got to label the numbers or you're going to get confused. That is a variable cost. Meaning that if you don't sell any of the software units, what do you think you're going to do? You're going to pack them up and take them home. Okay? So if you sell 0 units, you just pack them up, take them home, they're inventory, and you're going to sell them to somebody else later. This is fixed. We also call it in accounting a sunk cost, S-U-N-K. Which reminds me of, I'll tell you an analogy and a story. So here's my analogy. If you're running to catch a flight, which by the way, remember O.J. Simpson running through the airport? I did that in O'Hare. I ran about 400 yards. I felt pretty good. Getting here. We've had lousy weather, and I'm waiting in St. Louis, and my plane's delayed, and I've got to go to Chicago and catch a flight to San Francisco. Flight's delayed. I call the American, and I said, if I got enough time to catch, they delayed it 19 minutes. I think you'll be all right. Land, I have 19 minutes before the plane takes off. So I did my O.J. Simpson, and I ran through the airport. If you're running to catch a plane, think about all the costs that the airline has incurred already for that flight. They've already incurred the fuel in the plane, the insurance, the salary and benefits for the crew. They've already paid for the gate. They've already paid everything, right? So all the costs to the airline before that plane takes off are sunk or fixed costs. Sunk meaning you can't change them. So if I run up to the gate and buy a ticket at the last minute, what are the additional costs that the airline incurs? A bag of peanuts and a soda. There's virtually no additional cost if I run up and buy a ticket for the plane because all the costs are sunk, unchangeable. Unchangeable. So they'd love everybody to run up to the plane at the last minute. I had a whole row on my way to San Francisco. It was great. I wanted to lie down on the 3 seats and take a nap, but they wouldn't let me do that. So had somebody run on the plane and taken the seats in my row, that's just gravy. That's just extra revenue with virtually no cost. See what I mean? So my story is that back when TWA was headquartered in St. Louis, I had a job in 1997. Again, how many jobs has Ken had? I know. Where I would fly to Milwaukee, Wisconsin every week. And I'm trying to remember. So it's TWA, and I fly the same flight every week. Same guy working at the gate every week. So I have to go up and I have to change my ticket. And it takes a long time. And he finally gets it straightened out. So then I start to walk over here to buy a newspaper, and he says, "Sir, you don't have time to buy a newspaper. You need to get on this flight." And I turn around to him and I said, "The reason your airline is going bankrupt is because of this lousy customer service." Now, I shouldn't have said that. Because at that point, the guy got so upset, he followed me down the gangplank and came on the plane yelling at me. Boy, you talk about a hot button. There was one sensitive point, and I just went boom, and I hit it. But the airline analogy is a good one because all of your money's already spent. So, for example, I'll give you another one. If Christine's going to go out, this is a big one that I'm going to cover later when I do job costing. If Christine is set up to do a film documentary in Chicago, and she's incurred the cost to get there, bringing the equipment, hiring staff, the whole 9 yards in Chicago. If there's another film project she could do in Chicago, can you see that that could be just a huge win? Why? She's already there, right? So much of the cost of doing the second project have already been incurred for the first project. How many of you have seen a landscaping or a tree company working in your neighborhood and they knock on your door, right? "Hey, we're in the neighborhood. We'll come do whatever you want." Why do they do that? They're already there. So the extra revenue they get from doing your yard is just gravy. The trucks are there. They've already incurred the mileage expense. They've got the crew there. Why not go around and look for more business? Okay? That's how we use fixed costs to our biggest advantage. So, if you are doing work for a client and you, like Christine, have to physically go there and take stuff there, why not try to find other business? When I go on the road for this financial company, and I told you I fly in and fly out, we try to find other people that they can send me to and go see while I'm there. Sometimes it works out and sometimes it doesn't. Why? They've already paid for the flight for me to go there and the hotel and the rental car. Why not have Ken go see some other people? Leveraging, which is a term I'm going to use later, your fixed cost. Does that make sense? Back to our convention. You're going to buy a booth. It's going to cost you $2,000. It's a fixed cost. You're going to sell software at $30 a unit. Oh, your cost for the software, that's a cost, is $30 a unit. You're going to sell the item for $50 a unit. First question, break-even formula that's on the board. How much, here's what that means, and you're going to see it on a slide in a minute. How much do I have to sell so I at least cover all my costs? Or in other words, as it says on the right in yellow, how much do I have to sell so my profit is zero? In other words, third option, how much do I have to sell so I don't lose any money? Step one, don't lose money. One other thing on this slide. Variable costs change with your sales volume. The more units of software I sell, the more cost I incur for the software. If I don't sell any, I don't have any cost. Next slide talks about fixed cost. Fixed costs do not change with your sales volume. I've got to pay for the booth regardless. Example, fixed cost, the lease that I've talked about repeatedly. The cost of the lease will not change with the sales volume. You're stuck with the lease. Now, big point. Big point. Look at variable costs by unit. Only look at fixed costs in total dollars. Don't look at fixed costs by unit. I'm not going to go into why right now. Consider this in total dollars only, not per unit. I may or may not get to the reason in the course. It's not really germane. It's not really critical. Look at total dollars and fixed costs only. So on the board, consider fixed costs of the studio lease. It's $2,000 a month. Don't look at it at per unit sold. No. Total dollars. That's it. Okay? Important point. Next slide is the formula. Sales minus variable costs minus fixed costs. We set that equal to 0. Here comes some math, unfortunately. A little bit of algebra. The studio hosts, by the way, love algebra. We had this discussion. Can you do more algebra? What kind of, please do more algebra. Can we do some trigonometry? I took statistics in college, and I went to University of Kansas, big school, so I was in a class with 300 people. And I sat in the second row so I could pay attention, and I sat next to this beautiful girl who was obviously really smart. So every class I would show up and I would sit by her. And I was in a fraternity and she was in a sorority, and she asked me to do her Christmas formal. Well, that's nice. This beautiful girl asked me to Christmas formal. She called me 3 days before Christmas formal crying, saying, I have to study for the statistics final, I can't go. And I was like, come on, you're not going to go to your Christmas formal? I think she's just blowing me off. Turns out she really stayed and studied for the final. I did not, however. She studied. I can tell you I did not. The only thing I remember from statistics is Chi theorem. I don't know what that means. There was something called Chi theorem. So that's math. I am going to do a little math here. Assume that 1 unit is a photo for image photography. Costs $30 per photo. You sell a photo. Selling for $50, a fixed cost of $2,000. This math is the same math, but a different example than what I have on the whiteboard. Everybody with me? Okay. Here comes the math. We're going to solve for X, because what we're trying to find out is how many units do I have to sell to break even? Okay? 30 minus 50 is 20x. On the right-hand side of the equal sign, I add 2,000 to each side. So I get rid of 2,000 on the left and it moves to the right at this point. I divide both sides by 20x. I find out I have to sell 100 units. Now, what have I just figured out? In other words, Image must sell 100 units to cover all the costs, whether they're fixed or variable. So, at a minimum, I have to sell 100 units. Let me do the one on the board that has the same numbers. Just in case you didn't catch the steps that I explained verbally, I'm going to do them on the board. Okay? So 50 minus 30 gets us to 20x. And again, dollar sign, it's dollars. Don't forget the dollar sign. Very important. Okay? Add 2,000 to both sides. $20x equals 2,000. I know some of you are way ahead, but for the benefit of the audience, I'm going to do this. That's where I am now. There'll be a quiz later for the studio. Everybody's working on this. There's a quiz at the end of the course. Were you aware? You guys didn't know about the quiz? There's a quiz. How was Ken Boyd? You know, he was good, but he was really kind of a jerk at the end because he gave us a quiz. Really? A quiz? Okay. X equals 100. Now, you'll note that this is now units. It's not dollars. It's units because you're solving for X, and X over there is units. What did I just figure out? I got to sell 100 units. So what I have in one of my books is, the guy's not going to get on the plane and go to the convention if he doesn't think he can sell more than 100 units, because if he doesn't sell more than 100 units, he won't make any money. These are the kinds of conversations I think those of you in the audience have intuitively in your head, but you probably don't use the numbers. What I mean by that is, Christine's probably thinking, well, you know, I'm willing to go out of town and take this equipment and do this shoot, but how much revenue do I have to generate for that to make sense? I think you're doing it in your head. You're probably just not using the numbers. I think we all do this in our head. Okay? That okay? That's math. This is in the bonus material, the break-even formula. I'm going to talk about how we can improve this in this segment. Well, how can I improve it so it doesn't have to be 100 units? We're going to do that. There's no profit in this, by the way, right? So the next thing we're going to do is talk about, well, let's put a target amount of profit into the formula. Okay? Let's put a target amount of profit into the formula. Something called, and this is also in the bonus material as a formula, target net income. Am I covering my costs and generating a reasonable profit? Now you'll notice there's a change to the formula. What I'm going to do, I'm going to plug in a profit where the profit used to be 0. I'm going to plug in a profit, and I'm going to make the profit $1,000. And the math is going to change. The math is going to change. Okay? Here comes some math. You'll notice that everything to the left of the equal sign is the same. The number on the right of the equal sign, the profit, is now $1,000, and I'm doing the algebra. Okay? And again, I'm going to do it on the board because I sense that there's people out there who may benefit from seeing this all the way through. Again, 50 minus 30 becomes 20x, the dollar sign. If I add 2,000 to both sides, I'm going to do it a little abbreviated version compared to what I did last time. That goes away. This is 3,000. Okay? Divide both sides by 20. This goes here. X equals 3,000 divided by 20 is 150 units. What did I just figure out? To make $1,000, I have to sell 150 units. In other words, at the bottom of the slide, Image must sell 150 units to cover all the costs and earn a $1,000 profit. Okay? Is that okay?
I have a question. If you're doing this, your fixed costs are on a monthly basis. If you're doing this to evaluate, say, a project for the week, would you ever adjust your fixed cost to, say, that time period for the week, or you just keep it
Great
simple
question.
and keep it at a month?
Great question. Depending on the length of your project, you may change your fixed cost. So if the project you're working on is over 3 months, and you're going to incur, let's say you're going to use lease space for 3 months to do just one project, you would include 3 months of fixed lease costs, yes. Okay. You would adjust. Anything else on that? So now the question becomes, how can I improve my profit using the formula? How can I improve my profit using the formula? And what I say is consider under the tip at the top, consider each portion of the target net income formula. Okay? Let me do a different example. Those of you in the audience could take notes on if you want. I'm going to change the numbers. I'm going to say my sales number is now $80 a unit. I'm going to say my cost is still $30 a unit. That's my variable cost. And I'm also going to say that my fixed cost that used to be $2,000 went up to $4,000, regardless of what the fixed cost is. It's just the fact that it's one big fixed cost number. And let's say I want to make $2,000. Okay, just to give you some different numbers, and I'm going to work through them in a minute, so that those of you in the audience have the original example that was in the deck of slides and on the board, and now you've got a second example, all right? So how can I make things better? Well, you can sell more stuff, okay? What if I sell more stuff? Well, if I sell more stuff, I still incur the $30 per unit that I sell, but what about fixed costs? Does that change? By definition, the fixed costs don't change. This gets to leveraging your fixed costs. Leveraging. Okay? We want to get the most sales out of this $4,000 as we can. So if you're a plumber and your truck and your equipment on the road driving around is $40,000, you want to do as much plumbing business as you can with that equipment. As much plumbing business as you can. Why? You're getting the most out of the thing that the asset that you own. Before it depreciates, right? So one thing you can do is sell more, because while the variable costs go up every time you sell one, that's cost, the fixed costs stay the same. Variable costs change, fixed costs stay the same. That's one way to improve. So I say on the screen, sell more units while variable costs increase with sales, fixed costs do not. So in my example, if I'm able to lease the studio for $2,000, the more revenue I can produce with the studio, the better. So the more work that Creative Live can have in these studios and use the assets, which is the studio and all the equipment, the better. We call that maximizing sales using the same fixed cost. The plumbing truck example, we call it leverage. Leverage. I could lower my variable cost. Maybe in my example with the software, I'm able to negotiate a lower price for that software unit that I sell. Maybe I lower it from $30 a cost down to $25. Example up here, I'm a photographer at Image Photography. I lower my photo production cost per unit. Maybe I get a new supplier. Now, this is another thing that comes up in accounting. You got to be careful with suppliers and vendors, because cheaper is not always better, is it? Whether it's people in the audience are shaking their head. Whether it's hiring people, whether it's buying goods from a vendor. So if you're making Levi blue jeans and you get a new vendor for your denim that you use to make the jeans, if the material's faulty from your new vendor, the fact that it's cheaper doesn't help you, because now the material's damaged, you may not sew the jeans correctly, you're having to send stuff back. Cheaper is not always better. Now, cheaper is certainly a way to reduce your cost per unit and increase your profit, but you got to think about quality. You got to think about, is that person you hire going to show up on time and do a good job? Is your vendor for your blue jeans going to get you the denim to make the jeans on a timely basis? You got to consider those things. Cheaper is not always better, but it is a way to increase your profit. And the bottom one, way to increase your profit. The third one, lower your total fixed cost. You renegotiate your studio lease if you have a studio. Maybe I go to the client location exclusively and I do everything out of my home. Another friend of mine is in the appraising business. He appraises residential and commercial homes. When the economy was difficult, 08, 09, 2010, he shut down his office, started working at home because it struck, why do I have an office? Nobody ever comes to my office. I always go to where the business is. I don't need office space. I don't need office space. Okay? So that is increasing profit. Now I am going to do the, the math on this one, and then I'm going to go on to my other notes that are on the iPad to continue here. So everybody has another example. 80 minus 30 becomes 50x. If I add 4,000 to each side, this crosses out. This becomes 6,000. Okay? 50x equals 6,000. I got to divide both sides by 50. X is by itself. And I think x equals 300. That right? Why does that look strange? Not 300. Now I've got to do basic math. Now I'm struggling. 120, right? Does that look right? Yeah. 120. Now, this example is not exactly comparable to the other one that I did because multiple things changed from here to here. Look at the difference, okay? Variable costs were the same at 30, didn't change. Fixed costs went up from 2,000 to 4,000, but the selling price went up by $30 a unit, which is why, even with a higher fixed cost, we came out having to we had to only make 120 units in sales to get this profit that's even higher because our price per unit was so much higher. Okay, one more time. Variable costs the same at $30 a unit, piece of software. Fixed costs went way up. They doubled from 2,000 to 4,000. Well, how is it that I can sell less units and make a higher profit from 1 to 2,000? Because the sale price per unit is so much higher. Okay? Sale price per unit is so much higher. I'm going to go in my notes now and pull up other stuff for this segment. Segment 9. Can you believe it's segment 9 already? Unbelievable. Any questions while I've got one more page to scroll through? Questions?
We had a question come in from online, but it looks like you answered it just as it came in. It looked like you answered it, so they're all set there.
Okay.
Mm-hmm.
Okay. I'm going to go to one other document. And as I said, what I've done is I've pulled, here we go. I've pulled documents from, there we are, documents, from the two books, and I'd like to use some of this in our presentation. So to kind of spur my memory, I've got the detailed table of contents for the two books, and I'm going to use this to cover some other stuff, which is great because I didn't know if I was going to be able to get to it or not. Okay. Let me throw in one other kind of cost. So far we talked about fixed costs and variable costs, but there's something else called a mixed cost. Do we still make mixtapes, by the way? Is it still a thing? My daughter, for my birthday, always makes me a CD with music on it. We used to call them mixtapes. Is that still a thing? No? Playlist. All right. There is a thing called a mixed cost. And the classic one is your phone bill. Uh-oh, here's a graph. The first graph of the course. Okay? I'm putting minutes for your phone on this axis, and I'm putting cost on this axis. Now, Mrs. Boyd handles all the cell phone stuff. There is a point where my youngest daughter, Megan, sometimes she's texting so fast that I think her phone's going to catch on fire from all the friction of the texting. It's amazing how fast. I'm sitting there. It took me a while. I was doing it with my thumbs. Then I got good enough to do it with my fingers. It took a while. So your phone bill is the classic mixed cost. So maybe you pay $30 a month. Your cost is fixed. It's a straight line on the horizontal axis because this is your cost. And when you get to 500 minutes, it becomes a variable cost at 2 cents a minute. I'm just making numbers up. So it's possible to have a mixed cost. That makes the break-even formula harder to deal with. I really don't have a way of dealing with it in the formula you just saw, but I just want you to know that there's things called a mixed cost that can make this analysis harder, okay? So maybe those of you who lease equipment or lease space, there's a guy I know who works at a Panera in St. Louis because I'm always in there, and he's a drummer in a metal band that actually is getting a fairly heavy, big following, and they're recording an album. And he talked about studio time. And they worked out a deal with their music studio where it's a fixed rate, but then after they use it a certain period, they start to charge them differently. They'll start to charge them it's a fixed rate. So if you guys pay $1,000, you can use the studio from 2 to 10 hours. I'm making numbers up. But past 10 hours, it becomes a variable rate per hour. See what I mean? Music studio. Studio time is very expensive, from what I'm told. Those of you who are in that business. Okay? Is that okay? Okay. That is a mixed cost. And I'm scrolling through here. There it is. Okay? Relevant range. You can only use an asset that you have so long before it breaks down. So Christine can only use her camera for so long before it breaks down, okay? If Candace is selling products that we buy, we've got to use the products for what they're intended, right, or they break down. If you ask people in the trades business where they're buying nails or hinges or any kind of connector, there's only so much force you can put on that piece of material before it'll break and fail, right? You can only drive your car so many miles. So what I'd like you to keep in mind when you're planning your work, and if you're a filmmaker like Christine, that there's only so much stress you can put on the things that you're using before they break down. Now there's a problem when they break down. If Christine's in the middle of a film shoot and the camera breaks, that's a big problem, okay? If you're out repairing people's air conditioning when it's 100 degrees outside and the truck breaks down, that's a problem because you lose business. So a way of describing relevant range, I always called it redlining. You don't want your assets to redline. That includes people. You can only ask so much of your people, number one, and when people are working a lot of hours, I don't care who you are, your productivity is going to fall down at some point. Now, there are some exceptions. I know some tax accountants who have the ability to work insane hours doing detail during tax season, and their productivity never, I think they're like robots. Their productivity never falls off. It's amazing. Amazing. And they're doing detail. But for people and for your assets, please be aware that there's a relevant range that you can use them within. Do your cameras, Christine, at some point overheat? Do you have to shut them down?
Sure.
Yeah. So you got to plan for that. You got to plan for what I'll call idle time. My son was at home watching Jaws. He texted me, he said he was watching Jaws, which is a great movie. I snuck into a theater, I think I said, when I was 13 years old, and I saw Jaws in a theater, and it was terrifying. One of the things they talk about, you can find it on the web, the making of Jaws, A&E did a documentary. It was the first film that was filmed on the ocean. Because when they were going to make this movie, they assumed, well, you guys are going to shoot this in a tank in Hollywood, right? Steven Spielberg says no. By the way, he's only 26 years old. Nope, we're going to go film it at the ocean. So he asked Richard Dreyfuss to be in the movie. And he said, no way, I'm not going to be in your movie. You're going to film on the ocean? You're insane. That's going to be a disaster. Your film's going to flop. I'm not going to be in your movie. Because you can't imagine all the stuff that was going on that caused all this equipment to fail. It's all in salt water. That's damaging to equipment. They didn't account for all the idle time to fix and repair things, all this expensive equipment in the ocean, in salt water. You know, there's salt in the air, blowing around. Okay? So please keep that in mind. Where I see this being a problem is that people have their euphoria of getting a new client, and it's going to be a lot of work, and they don't step back and plan, okay, can I really shoot film for 2 hours? Can I really edit this complicated, project for 5 hours? Can I really get it done by that date? You got to be realistic. You got to be realistic. Okay? Relevant range, redlining. Redlining. Continuing. I'm going to talk about break-even formula just a little bit differently. And again, this is accounting-ese, this is jargony, but there's a point to what I'm going to put on the board next. And this has to do with profit. Well, that's stuck up there, but that's all right. This has to do with profit. Now, I'm actually going to go back just a couple of slides. Ben, if you could flip to the main slide for the course just for a minute while I flip this back, if you don't mind. Thank you. Because I want to tie what I'm going to do next to something that we already saw. Where do I want to do it? I'm going to do it on target net income. So we can pull up the slide again, and it's going to say target net income, okay? This is a different way to get you thinking about this formula to help solidify it, okay? It's called contribution margin. Another way of solidifying what we've already talked about to try to get that formula kind of embedded in your mind. Another way of saying it is your contribution to profit. This is going to make sense in a minute, I'm hoping. Candace, if you don't mind, can you give me a retail price for one of the things you sell?
$50.
$50. I'm going to make up a number and say that the cost is $40, the variable cost. Okay? 50 minus 40 is $10. Now, let me relate that to what's already on the board. I changed the example. 50 minus 40 is $10. Now, there's two things that $10 contributes to. It covers your fixed costs, and if you have anything left, it's profit. The $10 sales minus variable cost covers two things. It covers your fixed cost, and whatever's left is profit. This is another way of thinking about this formula. So what I'm saying is that Candace, in my example, has $10 per unit left, okay? And that can go toward two things. Let's say that she has $5 in fixed costs that she has to pay, and whatever is left is profit. Now, I'm going to make a point here. I mentioned that you shouldn't look at fixed costs, you should only look at fixed costs in total dollars. I'm just saying that this $5 per unit is getting contributed to the $2,000 lease that she has to pay. Okay? So she's driving down the road and she's thinking about, how should I price my product? So image photography, the owner Sarah is driving down the road, how should I price my product? Oh, I've got that lease I've got to pay for. It's $2,000. Well, I know my sales less my variable cost, my cost to create the photo is $10. I want to keep some as profit. Why don't I put $5 per unit to pay that lease? Okay? This is just another way of laying out the target net income formula. Brian, could I get some water whenever? Thank you. So I'm hoping that between contribution margin and the target net income that you see on the board, that's going to start to make some sense. Yes?
So, for instance, I have a lot of friends now who are starting businesses with like kind of social justice philosophies, etc. For instance, like sell one, give one, or sell one and 10% of each whatever goes to that. So how do you figure out what you need to make and calculate that? So if you're talking about like one unit really is 2 units because if you're giving one away, so how do you calculate all those numbers then?
That's great. Does anybody wear Toms? My daughter goes to a school where they all wore white dresses to graduation, and she got all the girls to wear white Toms. There were 80 girls in the class, and they all bought Toms because Toms donates a pair of shoes to the third world, I guess, right? So there's an example, too, where you give something away. So it's a good question. What I think you would do is, if one pair of shoes normally has a variable cost of 40, this would become 80. Which means you'd be working at a loss. So somehow you've got to raise the sale price to cover the cost of 2 shoes. So that what you're giving away becomes another cost. Okay? Other questions? So if you didn't get the target net income, you might benefit from thinking about it this way. This $10 goes toward fixed cost and whatever is left is profit. And the question is, well, for every shoe I sell, how much am I going to put over toward this fixed cost, the lease? This is fixed. Maybe think about it that way. Well, you're driving down the road. Well, I don't know. All right? That's contribution margin. I want to move into something, and I'm really glad I got to this because this relates to what a lot of you are doing, and that is job costing. Now, on the basic version of QuickBooks, it's very difficult. It's not possible to do job costing. I would recommend for this audience that you do this in Excel. Jackie O mentioned she does a lot of stuff in Excel. Do what I'm suggesting in Excel. Don't try to do it in QuickBooks. I think it's a little difficult. Job order costing. You're getting all this at no extra charge. That's amazing. If we might even throw in a set of Ginsu knives. Do they still make Ginsu knives? Remember those ads? Ginsu knives. I went to an Asian restaurant last night. I bet they had Ginsu knives. They gave me chopsticks And because I'm a hillbilly from St. Louis, I didn't use the chopsticks. My wife always refers to me as a hillbilly. When I do something, kind of geeky, you're a hillbilly. Job costing. Wish I could figure out how to use those chopsticks. Christine had mentioned, I believe yesterday, that she gives people estimates. How many of you give people estimates? Sure. In a creative field, you probably got to give estimates, I would think, because it's a little hazy as to, well, I'm going to ask Christine to shoot the film, or I'm going to ask Jackie to do this project where part of it is charitable. It's hard for a client to get a handle on what it is you're doing, which means it's probably a little hard for them to get a justification of the cost. So part of the job cost issue for creative folks is, let me explain to you what's entailed in doing my work. Now, it gets to pricing, which I'll get to later. I would just tell them your price and how you came up with it. So I'll get to that in a minute. I would not hesitate to tell people it costs $50 and $10 is my profit. And close your mouth and let them talk next. They may say, that's too high, or okay, or whatever. The price is $50, and I would just tell them, and 40 of that's cost, and 10% is and $10 is my profit. I'm okay. People should be okay with that. I'm okay with that. I'm all right with people telling me how much the profit is. They got to make a living too. We shouldn't have a hesitation to do that. Just tell people, here's my profit. Okay? So you're going to make an estimate. Now, there is an estimate function in QuickBooks. And when I pull it up today, I'll show it to you. You can have an estimate, and then you can create an invoice by using the estimate if you want. I've seen beginners in QuickBooks have trouble with that. So you create an estimate for client A, and then you're going to actually bill client A, and you put in an invoice, and now you've got an invoice and an estimate, and did I move the estimate and make it become an invoice? My suggestion if you're a beginner is just use the invoice function and not do the estimate function. People forget, did I do an estimate, and if I did I move it into an invoice? And am I double counting? All right? So Christine, do you mind if I use you as an example?
Sure.
So give me an example of some costs. Give me an example of a project, and you don't have to tell me your costs, but give me an example of some costs.
Well, let's say you're doing something like this. We'd have the cost of
You're
the
producing.
teacher.
Pardon me?
You would have the cost of
Instructor.
the teacher.
So give me 1 second.
Okay.
I'm going to say labor,
Okay.
and I'm going to
That
say.
covers a lot, yeah.
I took a picture of the whole production team, everybody who's involved today. So you've got the person who's on camera, and you've got, I'm just going to call it production staff. Okay, what else?
You got hosts.
Hosts. Okay, so that's all. I would call that all labor.
You call that production, yeah, so that's labor.
So that's labor. What else?
Equipment.
That could be one of two things. I'm glad you brought that up. For those of you in creative fields, that could be renting equipment. But if you own the equipment, it's a little tougher, isn't it? If you own the equipment, it's a little tougher. Let's think about that. If I rent the equipment, I'd have a rental cost. If I buy the equipment, it's probably not going to be in this job costing estimate. Because if I use equipment I own, I'm going to abbreviate equipment. That equipment's depreciating, right? That's the expense I incur for doing the work if I own the equipment. So for the most part, I'm not going to put that in the job cost estimate. It's still an expense. It's still going in my income statement, but I'm not going to include it in the job cost estimate. And I'm going to give you a reason why in a minute. I'm going to abbreviate depreciation. Because if I own it, whether I use it or not, it's depreciating. In other words, this depreciation is a fixed cost each year. It's a cost that happens no matter what. I hope I use it in projects, but if I don't, it's still depreciating. Okay? So I've got labor, rental. Yes?
So when you're saying job costing, this is not necessarily, this is what the exercise that you're going through yourself, because I'm wondering if you're going through this with a client, then
good.
it makes sense in my head that you would show them what 2 cameras, 3 cameras, 1 camera, because that is a whole different production.
It's really up to you. There's 2 things happening here. There is the estimate that you show to the client, and then there is your internal estimate. There's a friend of mine who does, St. Louis, who does very, very high-end home entertainment, okay? He does a job estimate. Now, he shows the client tremendous detail. So you have to make a judgment on how much detail you want to show the client. Do you want to show them 50 lines of costs, or do you want to just group them into 5? It's up to you. So your internal document may be really long, and what you show the client may be brief, okay? Labor, rental.
Craft services, food.
Services. Okay, so again, I'm just trying to create a job estimate that relates to people in this audience, okay? So these are the costs, okay? Say it's $1,000. So somebody says, I'd like you to film, a live production in a studio. You might even include studio rent in here if you want, although that's probably a fixed cost if you own your studio. So somebody raises their hand. They say, Christine, I want you to come to Chicago. We're going to give you the space, and we want you to film a live event with an instructor and host, et cetera. You need a production crew. And so you come up with an estimate. You go, here's my estimate, okay? Now, how you position your profit is up to your comfort level. Obviously, there's going to be a sale price here at the top. I'm just going to make it up and say it's $1,500. Many people in the trades, again, like I talk about plumbers, carpenters, roofers, landscapers. Some people show the price and they show the costs and let the client figure out what the profit is. Other people that I've seen will include the profit in there, which in this case would be $1,500 minus $1,000 or $500. It's really up to your comfort level. I suggest that you show them the sale price, the profit, and all the costs, okay? There's a third way to do it. The third way to do it is to show them an estimate with the costs already included, with no sale price. So, in that instance, you wouldn't have profit. You wouldn't have all you'd have is an estimate for $1,500, and that estimate includes your profit. So you're actually adding the profit into each of these numbers, and you're telling the client it's a $1,500 cost, which includes your profit. That's probably the most common way.
That would be my preferred way.
Yeah, so you mark everything up.
I don't want to haggle over profit
Right.
with the client.
Right. Depends totally on your comfort level, probably depends on your industry. My orthodontist drives 2 Porsches. He's got a Porsche SUV and he's got a Porsche sports car. The reason that my orthodontist drives these cars is because of the cost to go to an orthodontist. But he lays it out. Now, he doesn't show his profit, but he just marks it all up. Whatever you're comfortable with. Whatever you're comfortable with. I will say that showing your profit's probably a little gutsy. And if it's not your industry standard, that's probably a bad idea. Probably a bad idea. So we have this job cost. Now again, how do I do this in connection with my accounting and QuickBooks? I'm suggesting that you do this in an Excel document. You do this in Excel, Then if you get the work, we'll set up an invoice in QuickBooks. But I'm suggesting that you do not do this in QuickBooks because this detail, I think it's just easier to do it in Excel. Then when you get the work, you go into QuickBooks and you create an invoice. Is that okay?
How well do QuickBooks and Excel interface with each other
really
for
well.
job costs? Because
And I would go to a pro advisor and do that. It is possible, yes. It is possible to have, have somebody take the lines on an Excel document and dump it into QuickBooks for you. Yes, you could. I would go to a pro advisor for that, but yes. Okay? Other questions on that? That okay? So that's doing a job. Now, generally in accounting, there's two types of costing. There's job costing. So most of you who are doing projects are doing job costing. Somebody asks you to do something, you come up with the costs, you hand them an estimate, you do the work. Not most of this audience is process costing, where everything's the same, a factory. That's not really germane to this class, but it's called process costing. So you make pencils, and every pencil's the same. Completely different. Most people in this audience are doing project work, which means you're doing job costing, okay?
What would hers be with the cosmetics?
Hers, it slipped my mind. Candace's would probably be a product cost, process costing. Because she could, and like the one we were talking about before, where you have cost, I'll use the blue jean factory. So we buy the denim, that's a material. We run a machine and we pay for labor costs. We put the jeans together, we send them out the door. That is just a process. Just a process. It's not by project. All right?
No, I'm not sure if I understand this question exactly accurately, but when we were going over using the numbers for cost of material, is there a way to do that with pricing your service or talent, or would you basically just give yourself decide that rate and place that in where the cost of the material would be?
What I would do would be to take any cost and just add on a profit. So if you think that your talent is $50 an hour and you want a 10% profit, I would take $50 plus 5. So I price it to the client at $55 because I think my time is worth $50 and it's a $5 profit. Mm-hmm. All right?
Great.
Another conversation that Josh and I had, I can't fit it perfectly into this, but it's something else you should know because I get this question a lot. Well, let me leave this up. And that is between direct and indirect costs. Direct and indirect costs. The costs that Christine listed here, we could directly tie to the project, right? These are direct costs. But we have something called indirect costs, which are costs that we incur just by having the doors open, and we can't assign them directly to the project. Costs that we have for just having the doors open that we can't assign directly to the project. So, let's talk about that. Let's talk about what they are and how we deal with them. Typical indirect costs, all of you in creative fields are probably incurring them. We talked about insuring yourself for legal liability, insurance costs. Not related to the level of activity. You could do 5 film projects a month or 50. Let's assume you may be paying the same insurance premium. Yes, maybe.
Yeah, so that was going to be My question, because I know, especially if you're an artist or performer and you're performing in a certain venue, sometimes they require you to have additional insurance. So for that one day, you have to have $1 million worth insurance. So would that more be a direct cost, or would that still be an indirect cost?
Great question. That would be a direct cost because you incurred that cost specifically for that client. Yeah. And that's why I hesitated. Okay? These are costs that are not related to your level of activity. You write the check whether you do 5 projects a month or 50. Okay? Lease on your building, utility costs, all that kind of stuff. And the question is, and I'm only going to go part of the way down the yellow brick road for this, how do I include those indirect costs so that I can figure out my profit? And I think the answer to that is, I would just lump all those together as a fixed cost and understand that on the big level, on a macro level, I've got to cover those costs in my business every month. Let me show you what I mean. Let's say they total up to $2,000 a month. And you say to yourself, well, I can't really assign those costs to a job, to each project. There's a couple ways to handle it. One way is when you do your job cost, you could do this, and I've seen people do it. You somehow include in the job cost. You can also think of indirect costs as overhead. Your overhead. We've heard that term, overhead. You put overhead as some sort of rate on the job cost estimate. Now, there are people when I say that who say, well, I can't do that. People are going to, they're going to kind of hesitate at that one. I don't think they will, because I think people have to expect that you got to pay for your overhead somehow. Now, most people don't put overhead on their job cost. Instead, they say, well, I'm just going to look at my indirect costs in total and just keep this formula in mind and make sure that I sell enough stuff to cover it. Total. But another way to do it is to put it on your job, your cost estimate, and say, for example, that my cost is $2,000 for the month, and I'm going to do 20 projects, and so I'm going to charge everybody $100 for overhead. I'm going to abbreviate overhead. People do that. If you don't care to do that, or if that's not something you're comfortable with, or if that's not traditional in your industry, nobody else doing film production puts overhead on a job estimate, that's fine. I just want to make sure that you remember that you have to cover that cost. However you want to do it. Indirect costs. Any questions on that?
Would looking to like a past year and seeing how many jobs you did, would that be a good way to come up with a amount per project?
That's perfect. Look at it historically. And people that have been in business a long time have a handle on that. I mean, you could even build the overhead into the pricing of the other direct costs that we had on the prior slide. So when you talk about, production. Well, production on your estimate might mean the labor cost of the production plus some of the overhead. You can do it however you want. But I would hope, ideally, that somehow you start putting your overhead into the job estimate, because that tells you how much the job really costs. Because if you're leaving it out and you're not including overhead, just figure this out somehow. If you're leaving that out of your estimate, you're really undercosting your job. You're undercosting your job. Okay? I'll tell you in my case, I never budget for technology like repairs. And you know, I'm on my MacBook constantly. It's going to break down. I had to buy an $80 power cord. I paid $200. I have a Geek Squad that I had to pay him $200. I've got a budget for that. And every time it happens, I'm like, dang it. I should look at what, as Josh just said, well, Ken, what's your cost every year for that? And plug that in, because you're not recovering all your costs. Plug that in. Okay? There's a lot of cursing when my computer breaks down. Stomping around. At my house, I'm the only one who's not allowed to lose their temper. Do you have this in relationships? Only one person can be crazy at a time. I can't be crazy if my wife's going crazy. My children are all going crazy. 2 of my children are crazy all the time. But of the parents, only one person can be crazy at once. But when my computer breaks down, it's my turn to be crazy, and they're stomping and cursing. Usually what I do when I get mad, I put my head down and I shake my head, like when I was at TSA and they looked at my ticket and I said it was for somebody else. I just shake my head. And try not to lose it. Okay? Last thing in this segment, and I'm going to try to, let's see if I can get it done. Think about how much cost you're really incurring to do something. Think, how much cost am I really incurring? How closely am I looking at it is my point. Here's the example, because if you don't get this right, you can really screw up your profit calculation. So an example I use is, let's say you make shirts. You make 2 kinds of shirts. We'll put a sale price for each. Again, I don't go to the store. I don't know how much shirts cost. I found out Tuesday, Monday. When did I get here? Tuesday night I had to go to Macy's. I had to buy a shirt that I wore on Wednesday. I thought it looked nice. $50 a unit for one shirt, $70 a unit for another shirt. Let's say that you use the same sewing machine to make both shirts. So you've got cost, and I'm going to say, keep it easy, and I'm running out of time. The only cost is for a sewing machine to make the shirt. Machine cost. And you think that this one costs you $40 and this one costs you $35. So you think that your profit, and let's say that's your only cost, you think your profit on this one is 10 and your profit on that one is 35. Let's compare it to Christine shooting film. Christine thinks that one particular outdoor shot is going to take 2 hours of film time, and another one's going to take 5 hours, okay? So you've tagged the cost to do certain things. And because you've come up with a price and you've come up with a cost, you've got a profit. Okay? What if you're wrong? Because what you're assuming is that this product is 50 divided by 10, which is 20%, and this profit is 35 divided by 70, which is 50%. What if this allocation is wrong? If you look at your activity of your machine, or you look at your activity when you make your production, or you look at your activity when you manufacture your product, this product takes far more cost, $15 higher than this product. So this one goes up by 15, this one goes down by 15, and I've got to do basic math. All right. $15 went this way. See what I'm saying? When you really look at it in detail. Why is that a problem? It's a problem because look what's happened to your profit. Your profit for both products is now completely changed. That one's gone way up. This one's gone way down. Here's the moral of the story. Because you got the cost wrong, the percentage profit is different than what you think. You think you're selling $70 shirts and making 50% profit? That's wrong. You think you're selling $50 shirts and making 20% profit? That's wrong. So when you're planning your sales, your profit numbers are wrong because you got the cost wrong. See what I mean? So the moral of the story is take some time digging in to really find out what your costs are. All right? The next section we're going to talk about optimizing cash flow. There are some things that I will do on the board on cash flow, and there's also some things at some point today I'm going to start doing checks and deposits in QuickBooks and try to get to a cash flow bank reconciliation if I can.
Terrific. Well, thank you, Ken. And it is about that time that we need to take a quick 15-minute break. But before we go, we thought we would remind everybody out there, especially for those of you who have been following along throughout the past couple of days, that we do have a Facebook thank you card up for Ken. So if you'd like to let Ken know exactly how much this course has meant to you, you can head over to our Facebook page, look for the photo of Ken, and you can let him know what you thought of the course. And we also had a comment come in from Skeeta in the chat room saying, it's nice to hear these equations being talked about in a conversational tone. It really helps the understanding. Thanks, Ken.
Yeah, that is great to hear that quote from Skeeta.
It is.
Also do want to remind everyone about the Crunchies. If you missed us talking about it in the pre-show, we have been promoting the URL on the screen to vote for us as the best educational startup in this year's Crunchies.
We were nominated, which is quite the honor. TechCrunch is hosting, I believe this year is the 7th annual awards for the Crunchies, and we're very excited about it. So if you want to show your support, you can definitely head over to that URL and vote for us. You're able to vote once a day up until January 26th.
Yes, only a couple more days left, so get in there and get your votes in. So, in this course, we have been talking a lot about these formulas. This last segment, Ken went through a number of formulas that are going to be vital to your business and getting your finances in order. And as we mentioned earlier, one of our bonus materials, free with enrollment, is the list of all of the formulas Ken's been talking about. And this is extremely valuable because you can get all of these in one easy-to-read document. You can refer back to it over the next couple of months as you're getting taxes together, as you're organizing your finances. It's going to be a really important part of your workflow as you get your finances together.
And they're specifically formulas that Ken put together for small businesses, the specific formulas that you'll need, which is what makes them great.
Ken's been doing this for a long time. He knows all about this.
He does.
He's taken the guesswork out of it for you. This is his blueprint to follow. So it's a really great piece of material for you to follow as you go through the course. And keep in mind that you'll be getting those. You'll also be able to buy the course to have access to all the slides Ken's been showing throughout the workshop. That typically will cost $149, but as we're live for one last day, you can get that $99 special live price. So I think now's the time to click that green button, purchase the course, have access to everything you need to get your finances in order. And while you do that, we are going to take a 15-minute break. Hope to see all of you back when we return.
I'm learning to tell better stories.
I'm learning how to manage 200
Welcome back from break. If you're just joining us, we're entering into the second segment of our final day of Small Business Finance Basics with Ken Boyd here on Creative Live. We are about to get into the really fun stuff, optimizing cash flow. No, really, I mean, who doesn't want to optimize their cash flow?
Right, that's got to be a good thing.
Yeah, this is the stuff we want to think about, talk about, and optimize, right?
Yes, yes.
And just wanted to remind everybody before I let Ken get into the good stuff, we do have, Chris mentioned it a little bit before break, but we have some great bonus materials with enrollment, one of which is your book list, and the other one are business formulas, small business formulas that you specifically put together. And you can access that by enrolling in the course. If you click on the link directly below the feed, the title of this course, it'll take you to where you can enroll in the course, and then you can access those PDFs. So I wanted to make sure everyone was aware, and I will let you get to it.
All right, here we go.
Thank you.
Thanks, everybody. The first thing I'm going to start on is a slide from the PowerPoint, optimizing cash flow. In addition to, I think when I was flying out here, the two most important points that I wanted to make was the segregation of duties discussion that we had last time, yesterday. I thought that was really important. Optimizing cash flows runs a close second. Remember, we said it many times, but it bears repeating. There's two areas that tie up your cash the most. Accounts receivable for everybody when you bill people. And then if you carry inventory. And the analogy that I used is, if you start a business January 1st with $50,000, and now it's April 1st, and you've been profitable from January 1st to April 1st, but your cash balance has gone down from $50,000 to $10,000. And you say to yourself, how can that be? I was profitable, I'm billing, and I have more revenue and sales than I have expenses. How can my cash balance be so much lower? And the answer is, it's because it's tied up in other places, the biggest of which is accounts receivable and inventory. At the end of yesterday's segment, I did something on the operating cycle of how we spend cash and collect cash and spend it again. Think about that from yesterday's segment as we start into this section. Now, this section starts off with some more concrete examples about planning your cash flow. And I've got some little phrases below there that I hope will spur some thinking. The first is, did I invoice that client? I am notorious for this. I feel like it takes me a lot of energy and effort when I'm with a client online, giving consulting, training on accounting. Invariably, when I'm online, I get to the end and I forget to tell them how many hours we were together, what the rate is, and how much they should send me through PayPal. I can't tell you the number of times. Half the time, I forget to say that. It's a lot more effective to tell people what they owe and ask them to pay you in a live situation than it is to email them an invoice. So I have to always remind myself, ask for the payment at the end of this conversation, because that's the best way to get that payment in. So we'll talk about that more. What's my checking account balance? As you know, my son, shout out to Connor, the checking account balance is burned through quickly. What this means to you, though, is you got to know how much cash you need every month to the best of your ability. I understand a lot of us don't know how many projects we're going to do, but we probably have an idea of the cash for each project. We might not know if we have 5 projects or 7, but we probably know the cost per project. What I'm getting at is we can at least estimate how much cash we need. And if we can estimate how much cash we need, then we can deal with, well, how much cash do I have? How much cash do I have? And how much cash do I need to operate my business? Number 3 is a point that I talked about yesterday, which is if I'm adding clients, are they paying me on time? If I'm adding clients, are they paying me on time? Now, again, part of this is financial, but part of this is also personality. I've had people over the years that I love working with that pay me late, and I'm willing to live with it because I really like that client. Or, as Jackie O were talking about the last segment, with charities. If somebody's in a real crisis, I always tell my clients this, look, when I was coming out to Creative Live, and I knew I was going to be unavailable for this 3-day segment, I said, look, to my customer Mark, I said, look, Mark, if you get stuck and you're studying for your MBA final and you get stuck, I'll find a time to call you for 10 minutes to get you unstuck, and I'm not going to charge you for 10 minutes. It may be online, it may be just over the phone. I don't want you to sit there and be stuck, you know? Apply that to your clients. I'm sure there's plenty of times when you do something quick for a client that you don't bill for just because you want to keep the relationship and you like your client. In the same way, you may be willing to tolerate clients who pay late because you like the client, or they always pay, or they're a big client, or some combination. All right? So I'm hoping at the beginning of this segment to solve a critical problem. And I said it in this course before. Most businesses don't fail because they're losing money. Most businesses fail because they run out of cash. Now, they may not even fail, but they may have to go borrow money or sell ownership when they really don't want to because they don't have enough cash to get through the next 3 months, 6 months, etc. So while you stay in business, you end up doing something you'd prefer not to do. Okay? Accounts receivable and inventory tie up cash. I mentioned this story, but it bears repeating of this example of Paul the plumber who had plenty of revenue but was short on cash. It's worth saying again because this is so critical, and it's an example of a guy running a big company who was successful and in demand but was keeping himself up at night because of his cash position. I mean, it was literally making the guy sick. Paul has a residential plumbing business that does $3 million a year in sales. Everybody, we all get our plumbing fixed immediately. There's always a need. People always pay because you want to have a good plumber. I mean, I think you really need to get, when you move to a new city, you really need a good auto mechanic. And you got to find, a good handyman if that's not your thing. That is not my thing. That is not my thing. And you got to find, reliable plumber. You got to find reliable people. Paul was very reliable. He had business coming out of his ears, okay? But what Paul didn't do, and it's the last line there, is he didn't carefully consider how to use cash, and he made a big mistake. The mistake that Paul made, I'm going to go back and finish it there before I go on. The mistake that Paul made was he was in the residential business. That's the business that he knew. He took some cash and invested in a commercial business, which was putting plumbing into a commercial building, and it lost money. And because it lost money, he lost some of his cash that he used in the residential business, the business that he knows. As a result of that, he was constantly short cash. He's only about a week short, but he's constantly short, and he's never able to catch up. The moral of that story is two things. First of all, carefully consider how you use your cash in the business that you know, and be cautious of going into a business and investing in something you don't know. A big decision I have to make is, and I've talked to some of the producers about it, I'm going to start a slightly different business that is just geared toward consulting with businesses, and I've got to make a decision on how much money I want to spend on a website. I talked with someone at Creative Live who spent $4,000 on a website, and it was a home run, and this person got all kinds of business. Well, I'm going into a new field, a little bit new for me. It's going to be, for me, a pretty big expense. It's cash out the door, and I have to cash flow everything else in the meantime, and that's the conversation I'd like you to have with yourself. New area, got to invest some cash. How does that affect the business that I already know about over here? Because I could tutor people online forever. I know how that works. I know how much to charge. I know how to bill them. I know what to do. That's easy for me. I can do that in my sleep. But now I'm thinking about doing something new, and it's going to require a cash investment, and I've only got a bucket of so much cash. And while I hope that the new business will have big revenue and profit, until I get there, it's going to require sucking out some cash out of the bucket into that new business, and that's risk. And so you got to consider that. Did I invoice that client? It's common sense, but we so often forget in my example of not telling people what they owe me online. Bill your client as soon as possible and make the payment easy. I take PayPal for payments online, and I also use one other service that actually is going out of business, and I had a pay button for them on my site that I'm going to have to remove. But make it easy. So what do we mean by easy? Email them the invoice. Send them, if you're sending a physical good, put the invoice in the box. You could also email it. Make payment easy. Give them a link to the home. I have a link to the home page of my site. Here's where you go to pay me. Scroll to the bottom. Boom. Make it easy. Easy. I'm to the point where I don't even have a checkbook. All of my stuff is electronic. All my payments are electronic. All my payments from clients are electronic. In fact, you may consider offering a discount if clients pay you electronically rather than by check. Nobody gives me checks. Well, I take that back. My book publisher gives me checks. Other than that, I don't get checks. No checks. Quicker, easier. Send an invoice when you deliver your product or service, not separately. That's big too. Offer an online payment system using PayPal. A payment button on your site, that's great too. One of the reasons to spend money on your site, in addition to being creative, showing people what you can do, etc., and Creative Live is a beautiful site. I've told everybody here I thought the site was beautiful. Is to make payment easy and to make navigation easy, which is why our hosts tell you how to navigate at the beginning of these segments each day. Debit and credit card, that's obvious. Let me talk about discounts again. Offer a discount for early payment, but only in special situations, because as we mentioned, people are going to expect to get that discount every time. So you need to coach your client. Are you only giving them a one-time discount and that everything else is going to be at full boat? You got to coach your client on that, just to make that clear. Okay? The starting point for cash is, what's your balance now? So a reconciled bank balance is your starting point for calculating your cash needs. What's your balance now? Again, I highly recommend that you reconcile your bank statement within 5 days of getting the you reconcile within 5 days of getting the bank statement. Now, practically today, because you can get them electronically, you're going to get your bank statement on electronically pretty quickly. Please reconcile within 5 days so that if your records don't agree with the bank's records, you're fixing it and resolving it sooner than later. Reconcile within 5 days of receiving your bank payment, bank statement. Now let's go to kind of the process of planning your cash. First thing you got to do, and I know this is hard, and it can be a wide range depending on how many projects you do. Most of you are doing project work. Estimate your sales for the month. Mrs. Boyd gets angry when I overestimate my revenue for the month. That creates anger and gnashing of teeth. It's very biblical, gnashing of teeth. So to the best of your ability, estimate your sales for the month. So in my example here, I'm going to forecast $3,000 in photography sales this month. Your best estimate. Step 2, estimate your profit as a percentage of sales. Earlier today we did profit margin. In this example, if it's a 10% profit margin, that means you earn $300 profit on $3,000 in sales. The rest of it is cost. The rest of it is cost. Compute the costs you'll incur to generate the sales. Well, $3,000 at a 300% profit, 10%, means that 90% is your cost. This is an issue that most people don't consider, which is they don't consider, we all get excited about making a sale, but we don't think about the costs related to that sale. Because we got the jazzed up, we're euphoric about getting the sale and we don't think about the cost. And the question is, once we know that 90% of that $3,000 sale is cost, where are you going to get the cash? Where will you get the cash? Adding customers who on average don't pay as quickly can reduce your cash flow. Now I touched on this yesterday and I'm going to do it again because it's so critically important. Critically important. Guarantee you, if you're watching this course now and you grow your business 6 months down the road, if you haven't had this conversation about cash flow with yourself, or watch the video again, or talk to an accountant, or talk to somebody in your industry, it's going to get you in a bind. And again, not that I'm the answer to all your problems, but that you need to address this. Please address this, whether through me or somebody else. Adding customers who on average don't pay as quickly reduces your cash flow. So we said in the last example that your cash flow is $2,700 a month. Now I'm going to introduce a new thing, and it's in yellow. The average time to receive a customer payment is 20 days. So in 30 days, am I going to get all the $2,700 back? In theory, yes. Result, the entire $2,700 in costs is collected within a month. What's the cash impact? There's no need to add cash for the next month. It's all good. Do we still say it's all good? Is that passé? It's all good. My daughter, Megan Boyd, shout out. All of her 8th grade friends have a saying now where they all say same. Is this out in California yet? So all these little 8th grade girls, they're in the back of the car. Yeah, I watched this show and I really liked it. And the other girl goes, same. That means, I agree. Same. Same. But I'm not allowed to say same. Because if I say it, it sounds ridiculous. Dad, stop it. Same. So shout out to Megan. There's no need to add cash for the month. Now we have a situation where you sell more, but you're paid more slowly. This relates to getting in an area of business that you're not that experienced with, like me. So I have a very specific plan to do one-on-one intensive. It's got to be in-person consulting with business owners, and it's very targeted, and there's about 12 problems I can solve. And Mr. Client, if you don't have these 12 problems, good luck and God bless, I really can't help you. It's very specific. But here's the variable I don't know. The variable I don't know is, how quick am I going to get paid? Because over in Ken online training land, I get paid right away. But in new consulting land, how soon will I get paid? Because I could get myself in a situation where if I combine the two businesses overall, on average, I get paid too slowly to cash flow. I get paid too slowly to cash flow. Here's an example. Revenue goes up to $4,000. That's good. The profit margin is the same. It's a 10% profit margin, which again means 90% cost. 90% times $4,000, $3,600 a month is my cost. Revenue goes up, costs go up too. Here's the problem in comparison with the prior slide. The average time to receive the customer payment is now 40 days, not 30, not 20 or 30. The problem is I'm not recovering all my costs within 30 days, which means after 30 days, I need more cash to do business. Okay? Big, big big issue. I'm going to take that example and I'm going to do something I did yesterday because it's so critical. Other than segregation of duties and the fictitious payee, this cash flow is the most important thing, in my view, that you'll take out of this class as a viewer. Okay? We talked about an operating cycle. Where we said, I'm going to walk off just for a second. Sorry. We get an order. We spend money to fulfill that order. We deliver a product. Or a service, could be either one. We collect money. And we turn around and we do it all over again. And the point I was trying to make yesterday, the goal is, a couple goals. I didn't do it in this format yesterday, but let me do it to try to clarify. There's a couple goals in the operating cycle. For one, I'd like to, if I can, reduce the outflow of money to create the product or service. We talked about that when we did target net income and break even. I'd love to lower my variable cost by getting a new supplier. I'd love to lower my lease cost, the fixed cost, by renegotiating my lease. So part of the goal is I'd love to spend less money. Another goal is related to cash flow. I'd like to collect the money faster and speed up this process. So for all of you out there, you need to think about how long does it take me on average to collect money? If it takes you 20 days, if it takes you a day, think about that. Because how fast this circle moves has everything to do with whether you're going to have enough cash to operate. Okay? Let's do that example from yesterday. It's so critical. Let me flip to a new page because I'm going to do a couple of steps. Okay? Yes?
So I have a question about even how you organize your business and whether it's push or pull, whether you're B2B or B2C, business to business or business to customer. Because for me, some of my products, we don't even go into production until we have an order. Until I know that you've ordered $20,000 of XY widget, I'm not even going to production because it costs me too much to produce it and store it for that different thing. So how does all that factor into that?
You're actually in better shape, and let me pull this back over. For a couple of reasons. You're not carrying inventory, which means your cash is not being eaten up by inventory. And you're not spending the money until you get an order. While some people are spending the money on inventory 3 months before they sell something, you're not spending the money until you know you have an order. So your cash flow cycle is faster. So those are two good things. Ideally, it would be great if everybody could avoid spending money until they had an order. That's ideal. Okay?
But her delivery of product would be slower.
It may be, yes, which means let's just put some days on it. And this is the psychology of when I put 20 days and 40 days on average time. Let's expand that. If it takes you 20 days to make the product and 30 days to collect the money, you're not going to get around back on the cycle for 50 days. To give you an idea. So now you know, 50 days from the time they call and place the order until the time I get the money in here, it's 50 days. Businesses know this. Big businesses know this. They got it down to the day on average. Okay? I'm going to touch on something you can do for budgeting that expands on the cash flow that I did yesterday. I think there's a QuickBooks template on it, but I think you can just do it in Excel. Okay? And I'm just going to call it a cash forecast. Okay? You have a beginning balance in cash. Let's say it's February. We have a beginning balance in cash, abbreviating, 50,000. We're going to have inflow, and we're going to have outflow. And at the bottom, we're going to have an ending balance. And you should know that the ending balance in February is going to be what for March? It's going to be the beginning balance for March. So whatever a number I end up with here at the end of February is going to be my beginning March. And now you can see visually, oh, yeah, how much cash do I have at the beginning of March? Because what you want to avoid is to have some of your cash outflow as a new bank loan or selling interest in your business to get enough ending cash to get to the beginning of the next month. Okay? Cash inflow is going to be receivables in your business. And that's going to be based on past month's sales. So you estimate based on people who owe you money from January and people who owe you money from December, still at the beginning of February, you estimate that $30,000 is going to come in. That's a plus, that's a positive number. To spend money to make your product or service, that's going to be an outflow. I'm just going to call it new production. That's going to be an outflow of $40,000. The reason you're going to have this bigger outflow number is that you're adding business. Okay? Great news that you're adding business, but it requires more outflow. So if I add it all up, my ending balance is now $10,000 lower, which becomes my beginning balance for March. Now, because I created and sold more product in February, you would think that my receivables in March are going to be higher. Let's assume you collect within 30 days. So you're going to collect the whole $40,000 plus $40,000. But you increase your sales again in March. So your outflow in March is now, I'm going to say it's $50,000. My ending balance is now down to 30,000. I was right. I hesitated. So here's what's happening in this business. You're selling more stuff, that's good. Receivables are going up. But the money that you're paying out for product is also going up, and your ending cash flow is going down. Now, all of these variables can certainly change, don't get me wrong. But this is the kind of, in Excel, easy peasy. This is the kind of analysis that you should do for yourself. And you can have separate schedules that say, okay, I'm owed $5,000 from December, and I'm owed $25,000 from January, and that adds up to 30. Or here, I'm going to have X amount of sales, and I know that 70% of that is cost, and that's how I got the 40,000. So these numbers may be figured out below, and then this is your master document, and so these are figured out below here on a spreadsheet. And then this is linked to this, and the ending balance in March is linked to April. See what I mean? And it's called a roll forward. It rolls forward. An accountant would call it a roll forward. Okay? I want to do some of these ratios. It's so critically important. I want to do these ratios again, but let me pause here. I would love it if you're online watching this. I would love it if you would do this. I would love it if you would do that. Okay? How was the 12-hour course? He asked me to do one spreadsheet. That was all I remember. But if that's all you remember, that's a good one to remember. Ratios that relate to receivables and inventory, one more time, so critically important. Comparing, let's do receivables first. And we're talking about ratios. Looking at sales versus receivables. You can do this a couple of ways. One I talked about yesterday, one I'm going to introduce as new. A simple way to look at it. What is my average receivable for the month? So, 1 month you're owed $10,000, 1 month you're owed $12,000. I'm just talking about an average. I'm going to make up a number and say it's 10,000. Compared with your sales of 100,000. I got to put dollars. I'm breaking my own rule. I got to put dollars by these numbers. What that means is that you are, quote, and I didn't use this term yesterday, turning your inventory, turning over that receivable 10 times in a year, if this is annual. So what that means is that you collect all of your receivables and sell $10,000 worth of stuff and collect it, sell it, collect it, sell it, collect it, sell it, collect it 10 times. The goal would be to minimize your receivable and to maximize your sales so that you're turning it and turning it and turning it faster and faster and faster and faster. Hey, I'd love it if my receivable was only $500 and I was selling $100,000 a year. Wow, that'd be great. Turn, 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 turn. Okay? Because the less receivables you have, the more cash you have. Less receivables is more cash. Okay? All things being, if I've got 10,000 in receivables and sold 100,000, that means I got 90,000 in cash. If I've got $50,000 in receivables and sold 100, I've got $50,000 in cash. Okay? So that is comparing, yes?
I think we have a question.
I'm sorry?
What kind of business would that be more obvious, the sales versus a receivable situation? Because I'm not sure if I see how that would apply in like a photography situation.
It applies to businesses where clients traditionally take a longer time to pay, or take a longer time to pay, maybe not the whole bill, but some of the bill. So the construction business, people that do commercial construction, I have friends in that business. I wouldn't want to be in that business for this, and this is one of the reasons. If you're in a business where you do progress billing, and you may do this if you're a creative person in your work, where you bill people as you finish a percentage of the project. So if the job's a $100,000 job, when I'm 20% done and I can prove to you that I'm 20% done, I get paid 20% or $20,000. It's called progress billing.
Okay.
That is an industry where that would be applicable, yes. So anyone, and I'm glad you brought it up, Renee, anyone who bills, can only bill your client in increments because they want their cash, has this issue. Okay? That's receivables. Let's talk about inventory. Renee, if I write down this low, can you see? I don't think you can see. Can you see? All right. Is the red marker showing up? Is that all right? Sometimes red and green fades. All right. Compare average inventory on average. You know, sometimes it's 50,000, sometimes it's 30,000. Your average inventory with your cost of sales. Now, let me just reiterate, because we saw it in QuickBooks. When you sell an item in inventory, inventory is an asset. When you sell it, it becomes a cost of sales and expense. When you have an item when Candace has an item in inventory, it's an asset because she can make money by selling it. When she sells it, it becomes cost of sales, which is an expense. You've used up the asset, in this instance, by selling it. All right, just to clarify these two terms. Okay? Let's say on average, Candace's inventory is $30,000. I'm going to put a dollar sign. And her cost of sales is $300,000. Same thing here. She is turning inventory, in this case, they call it inventory turnover, 10 times, which means in theory, she opens up her warehouse door, there's $30,000 of inventory on the shelf on January 1st. She is selling all the inventory and buying all new inventory 10 times during the year. And the idea again would be, I want to minimize the inventory that I carry because it ties up cash, and I want to maximize my cost of sales. Now Jackie O says, well, I don't start production until I have an order. So she does not have inventory, which would be ideal. So what we've done is two things. Remember, what two things tie up your cash? Beginning of this segment, receivables and inventory. How can I get a handle on whether or not I'm doing a good job collecting cash? Here are two ratios, two comparisons. Real easy. You can think about this in the car. You know, well, my goal is to sell $300,000 this year, and lately I've been carrying $30,000 of inventory. You might think that's good or bad. Because if you reduce the receivables and the inventory and you increase your sales, which is comparable to cost of sales, you tie up less cash and you collect cash sooner. So you want not only less receivables, but you want less inventory. Because this ties up your cash. So we want less of it. This ties up your cash, I want less of it. Receivables, inventory, reduce it. Okay? How's that? Mm-hmm. By the way, those of you in the audience think I'm drinking water. It's actually gin. Third day we drink gin. Gilby's gin. Just smoke bottle of it back here by our producer. Okay. I want to do one more example, so critically important. Rolling through this cash over 3 months. I'm just going to do this one last time in the course because I think it's so critically important. I'm going to call it cash inflow, outflow by month. Now, we've seen this, but I felt like yesterday, thank you. I don't think I rushed it, but it was at the end of the day, and I know that people start fading at the end of the day, and I'm just going to do this one more time because it's critically important. January. I'm going to put sales, cost of sales, profit. Thank you for the water, by the way. That was actually water, it wasn't gin. Okay, one more time with feeling. You have sales of $50,000. I'm going to assume that you have a 10% profit margin. Well, let me do it over here. That means 90%. Now, I'm going to do profit differently each time. Do I want to do that? I'm going to leave it at 10% profit every year. Let me do that. I want to make it easy. All right. That means 90% of your 90% of what you collect is cost. Okay? 90% of 50 is 45,000. I have a profit of 5,000. Dollars. Okay? Sales go up in February. 70,000. Oh, now I got to start doing some math. My profit is 10% of 70,000 or $7,000. %90 of 7 is 63,000 cost. Uh-oh. Where am I going to get the extra 18,000, 18K? Question mark. Ooh. One way is to make sure that my beginning balance in cash plus what I collect from these sales is enough to cash flow this. My beginning balance in cash plus what I collect for January is at least this number to cover my cost. If you're sick of this, I apologize, but it's too important, and I just have to do it one more time. March. Oh, by the way, I'd like to apologize to the University of Kansas because this reminds me of March Madness, and somebody at Creative Live told me, you know, I pick your team, the Kansas Jayhawks, every time in my poll, and they always lose. And I said, yeah, lately we've been underachieving, so I'd like to apologize on behalf of my university. I apologize for all your Final Four brackets. I had a friend of mine who gets very emotional at watching KUJ. Now, we've been out of college a long time. So his daughter showed me without him knowing, did a video of her dad watching a game, an NCAA game when her dad this is not his nature, he just totally loses it. He's in a chair, he kicks his foot, he throws something, hilarious. He doesn't know that she filmed it and that she shows everyone. God damn it, he's kicking. And it's not his nature at all, it's hilarious. 10% of 90,000 This is 7,000 for one thing. I'd love to make 70, but 7,000. 10% of 90,000 is 9,000. That means that $81,000 is our cost. Again, where do I get plus $18,000? $18,000 even higher. So now my increase from January to March, I have to get $36,000 more dollars than what I started with in cash to support the growth in sales. Okay? Please consider this as you grow a business. Please consider this as you grow your business. So critically important. Okay?
Tracking inventory. The Guava Project online in our chat room was asking, how do you track perishable inventory, say cupcakes or something that they'll have for a certain amount of time but won't be good forever?
So let's talk about that. You have inventory, and it's perishable. I used catering as an example earlier. Let's say it's $10,000 worth of goods. We debit to increase an asset account called inventory, but it's got a shelf life that's short. Grocery stores, same issue. Let me talk about an accounting jargon, and then I'll specifically answer the question. What happens when it's spoiled, obsolete? Hopefully you time it so that doesn't happen. If it is obsolete or spoiled in this case, let's say $1,000 spoiled. That $1,000 is going to become an expense. You're going to treat it as an expense just as if you sold it. So what happens specifically is your cost of sales number, which is an expense, EXP for expense, is going to go up. So what we're going to do is we're going to reduce by crediting our inventory 1,000 for this number. That's a 1, by the way. And it becomes an expense. We debit to increase an expense. That's how the accounting works. My point being, if you have limited shelf life goods and you don't get them out the door before they spoil, it's an expense. So, in your planning, you can do a couple of things. First of all, we've already heard the song all day long about minimizing your inventory, period. So how does somebody in a business where they're a caterer and they're cupcakes, how do we minimize inventory? As Jackie O's pointed out today, it's in the auto business, they called it just-in-time inventory, where we only have a product when we have an order for it. We have no inventory. So limit the amount of product you make in advance, is what I'm saying. Or maybe none at all. You minimize your inventory by limiting the amount of product that you make in advance. Another client of a friend of mine supplies thousands of goods, literally thousands of goods, to the 2 biggest grocery store chains in St. Louis. That business will pull your hair out because not only do they have to go out to 1,000 vendors, get their products, and then get them to the grocery store, but they have to deal with the spoilage issue. Yes?
Is there a functionality within QuickBooks that you can monitor trends over the years? So you can see in February, around the 14th, I sell twice as many cupcakes as I do normally, and you can kind of forecast for future years?
And this is a reason why you should, even if you're doing it manually, where it would be great if you got on QuickBooks as soon as you could, so that history is in there, so you can run reports like that. When we go in later today, we're going to see, we will go in the next segment. there is a budgeting field that I think you and I saw yesterday, but there's also a place you could click that says trends, and that's where you find it. Okay? So that's how we deal with obsolescence. The one I always use in, what if it's not a perishable good? So the one I always use for obsolescence is, and this applies as you grow your business, bankers lend money on assets. It's called asset-based lending. They're going to lend you money using your assets as collateral. Bankers sometimes lend money based on your inventory. That's your collateral for a loan. Okay? Called asset-based lending. Take out a mortgage, your house is collateral for your home loan. Take out an asset-based loan, your inventory might be collateral for the loan. Now, here's the catch, and here's how it relates to obsolescence. Your friendly neighborhood banker, who, by the way, when he gets up in the morning, do you know what bankers do before they get out of bed? They look at all four corners of the bed and they make sure it's okay to get out of bed. They're very cautious. Look at all four corners. Is it all right? And then they get out of bed. Did you know that? Ask a banker. All bankers do that. They're cautious. After all, they're not lending their money. So, your banker is going to probably come out and want to do what? If this is collateral, what's he going to want to do? See if you really have the inventory. Which means he's going to count it. Now, let's say that you, again, I don't go to stores other than when I had to go to Macy's on Tuesday. Let's say they go in and they're going to count Macy's inventory because Macy has a loan with a bank, and the men's furnishing department inventory is the security for the loan. It's the collateral. And they go in there and they know, my example's getting passé, but I'm going to use it anyway. They notice that in the men's store inventory that they have bell-bottom rhinestone jeans, and they also sell mood rings. If people aren't buying bell-bottom rhinestone jeans and mood rings, that inventory might be considered to be obsolete. Obsolete, not sellable, and if it's not sellable, it's not an asset. Obsolete, not sellable, not an asset. And if that's the case, you've got to expense it as a cost of sales. It's not an asset if you can't sell it to make money. Pet rocks. They might ask you to write off the pet rock inventory because people don't want pet rocks. Really showing my age, okay? Does that make sense on the inventory?
So what do you do, throw it away after that?
Literally, you may discard it, or you may be able to find a vendor who will take it and maybe can make it into something else. Disassemble it and make it into something else. So if it's denim and you've got the bell-bottom jeans, you may have a manufacturer who's willing to take it and use the denim to make something else. And maybe it's so expensive to do that, you wouldn't do it yourself, but they could make money doing it. There was a situation, who was it? This is a good example of this. Martha Stewart clothing line, okay? J.C. Penney, I believe, bought up a ton of Martha Stewart clothing in inventory to promote, and they were going to do a huge marketing promotion and sell a bunch of Martha Stewart living clothes. The problem is they didn't legally have the trademark to do it. Another store did. I think it was J.C. Penney. I can't remember exactly. So what happens? J.C. Penney, the department store, has bought all this inventory that they can't legally sell. I read the headline twice, and I'm like, that can't be. There was a trademark dispute over who could sell it, and the judge decided, J.C. Penney, you can't sell tens of millions of dollars of merchandise. They're stuck with it. What do they do with it? Well, about all they could do was sell it to the people that had the trademark who could sell J.C. Penney Martha Stewart clothes. What do you think they were willing to pay for it? Not very much, as little as they could, because it was either sell it to the people who had the right to sell it or throw it away. Crazy. It was in the Wall Street Journal within the last 6 to 9 months. Crazy. They didn't have the right to sell it. What else?
Well, how would that look on the T accounts if, okay, you find a buyer for it, but you've already expensed it?
You would undo this and you would put it back in inventory.
Okay.
And then you would take it out of inventory and it would become a true cost of sales. I would undo it, but you'd have to. You'd have to put it back in and say, okay, it is inventory because I do have a buyer, and then move it to cost of sales. Yeah. Other things on that? Is that okay?
We had a couple questions come in the chat room. One in terms of tracking estimates, but they were kind of asking how to do that via QuickBooks, or if that's something you even should do.
You can put a budget into QuickBooks, certainly, and I'll try to remember. I know that Jackie O wants to see it. You can certainly create a budget in QuickBooks, and we're going to talk, I think I'm going to talk, I should be talking now about budgeting versus actual results.
Okay.
Mm-hmm. So let me go back to my outline. Bear with me. Documents, detailed outline. We're in segment 10. Can you believe we're in segment 10? Wow. Okay. Get out of that document, go back where I was. Bear with me 1 minute, I'm sorry. I just want to make sure that I get to where I want to go. Here we go. I'm going to talk about, in the time we have remaining here, this bleeds over a little bit into the other segments, but this budgeting process, because you need to see it here before you see it in QuickBooks. This paper sticks, and so I have to be careful. So, I'm all for budgeting. There's a term called variance, and it's defined for accounting as the difference between your budgeted result, your budget, less your actual results. Budget less your actual results. Now, that's the definition. So I would recommend QuickBooks somewhere that you create a budget. When I just went through the cash flow and I did a couple of different examples of that, that was budgeting. What if? What if? Do that what if analysis. Okay? The reason, the why here we do variance is to find and fix problems in your business. Find and fix problems in your business. I'm going to hit upon a couple just to get your mind kind of thinking about that. I'm actually not going to set up one, but I'm going to talk about some specifics and the fallout from the decision that you make about the variance. Labor. Say your labor costs are higher than you budgeted. Well, there's some things to consider here. Maybe it was higher. Maybe you had to pay a higher hourly rate because of the demand for the people that you hired. So if you're making film and Christine's got to go on the road and hire an assistant producer, and her labor costs are higher than she thinks because the market to get somebody that she needs is higher than she thought. So she budgeted a lower number for the assistant than she actually paid. She actually has to pay more. Okay? Another one, less obvious. Maybe the person was poorly trained. Or maybe the person lacks experience. And it takes them longer to do what you asked them to do. I got to come back from Creative Live. I think I finally figured it out. Got to come back. I finally figured out how to do it, right? if people are poorly trained and you think it's going to take them 3 hours and it actually takes them 5 hours, your budget for that expense is going to be less than how much you actually spent. Another example, a friend of mine does HVAC contract. He puts in heating and cooling in buildings. We're a heavily unionized city in St. Louis and Missouri generally. We're more like an East Coast city in that regard. And he works with union pipe fitters. 80% of his costs, sometimes 90%, is labor costs to hire these pipe fitters. The make or break on the job, whether he earns a profit of 5% or loses 5%, is how efficiently the guys work on the job. So it's critically important to him to always hire the same guys who know what they're doing. Because if you get a bad apple who's poorly trained or, doesn't work quickly or efficiently, doesn't ask questions, he's going to have a higher labor cost than he budgeted, and he's going to lose money. Guy's been doing this business for 25 years. Tough business. Now, there's a risk, obviously, if Christine hires an assistant production person and decides that they're too expensive and goes out and hires someone else for a couple reasons. Number one, maybe you, Christine, or anybody else out there, you are going to have to retrain somebody new. That's an investment of your time. Is that person going to be as good as the other person you had? There's a quality question here. There's a quality question. So critical. Quality. Is the quality going to be as good? So for people here, because most of you who are creatives, this is a people-driven, this is an expertise, people-driven industry. You got to carefully consider people. What about material? Material is a little easier to understand, I think. Material costs. And I can pick on Christine again, and I can say that she's considering a new camera. And she's budgeted $2,000 for it. The camera that will get the best results is $2,500, but she decides to buy the slightly lower-end camera because it fits her budget. And the question is, quality. Will it do what it really needs her to do? So we stayed within our budget, but are we hurting ourselves from a quality standpoint because it just doesn't do what we thought it would do? That could be film equipment, a website, a web application. I know we had a question, I think it was on the first day, about is there open source accounting software, and I said I wasn't really sure. Well, the question there is, I'm not knocking it, but compare how much you're willing to pay for a piece of software with what it can do. Is it supported? Will it go down? Is it easy to understand? Those kinds of considerations, because a lot of you in the creative world are looking at technology tools. I asked for my son what equipment they used to edit here, and they said it was Adobe Premiere, which he has used, and that they used to use. There was another one that they used to use that Steve told me, I don't remember. But that's a quality consideration. You don't want to go cheap on the software where you edit and have your editing take longer than you think, which is more labor cost, and look bad on the web. So you better go, get what you need, even if the actual cost is more than you budgeted. So I would suggest that you budget, certainly. I would suggest that you look at the budget and the actual results, because that is a red flag to find a problem and try to fix it. But if you do fix it by going with something that's cheaper, I'm suggesting that there are some quality issues there. Okay? One last thing on budgeting. These are budgeting costs. You're also going to budget sales. And this is so closely tied, again, with something that is not a budget issue, which is cash collection. cash collection. You budget $500,000 in sales. You actually sell $600,000. That's great. But again, the other consideration, oh, you sold more than you thought. Then you budgeted. That's great. But the other consideration is, again, because it's so critical, are you collecting money at the same rate that you were when your sales were lower? And if you're not collecting as fast, you're going to need more money. You're going to need more money. So what I tried to get across in this segment is how important cash flow is. I showed you some of the ratios that we use for inventory and receivables. I showed you that cash flow roll forward, which I highly recommend that you do in Excel. If you're watching the course, you can rewind to that point. Take a look at that graphic that I put on here, and please do that in your business. We talked about the turnover ratios. And finally, we talked about a budget. Any questions?
I'm just thinking about how much of this actual exercise should you do with your actual clients, because a lot of what you budget has to do with what their budget is.
Absolutely.
And what their expectations around the result will be. And I can think of, like, even for video production, if you think of somebody may say they have a budget of, let's say, 10 grand and they want X, Y, and Z, which you know in your mind is not possible with 10 grand. That's going to be a $30,000 budget. And there's different things they can manipulate on there. But if we have a lower labor costs, right? The person may not be as good, and it may in the end cost them more.
You just completely nailed something that I should have covered long ago, which is in creative fields, your clients are going to have their budget. Who's seen Ferris Bueller? Do you remember the scene when he runs into his dad at the restaurant, and his dad doesn't see him, and they're getting in the car, and his dad's in the advertising business, and he's trying to explain to the guy, you've got to have a decent advertising budget, or it's just not worth anything. So there's two issues. The first issue is your client has a budget. And I know accountants, and boy, we love budgets. So there's a problem. You either need to come within their budget, and if that's not realistic, you need to explain to them, in order for you to get the results you really want, you need to either increase your budget or I can't meet your need. And this is true for everybody out there watching this. Because you guys are creatives, and it's difficult for you to communicate the value of what you do. And this is why, I'm begging my son to finish his personal website, which many of you have, because that's your way to communicate, where you can say, you see this? If you want this video, film, project, it's going to cost you this. And it's more than your budget. But if you'll pay more, you'll get this. That's critically important. So, I hope that everybody really, really takes a look at this section, and that if you buy the course, if you go back over it and look at some of those things I put on the board. We are going to go back in QuickBooks for the next segment. I'm going to create an invoice. We're going to pay expenses with checks. We're going to create payables, and we're going to do one last round at QuickBooks. And we're also going to talk about documenting and training staff.
Great. That was a lot of the questions that we did have come in over this segment had to do with going into QuickBooks. So we'll tell everybody to hang on, and we'll get to it next segment.
Yeah, we are coming up on our 45-minute break. Before we do go, I want to remind everyone that we do have that Facebook thank you card up for Ken. And you can get to this by checking out the Creative Live Facebook page, facebook.com/creativelive. You'll see a photo there of Ken, and there you can leave all of your comments and just leave your thank yous, what you thought of the course, anything that you want to share that you enjoyed over the last couple of days. And as you guys are doing that, we will be sharing them as they come in through the rest of the workshop. So keep those coming. I do want to read one that's already come in from Jester. And they say, thanks very much, Ken, and thank you to our chat moderator, Alexa. This is probably the biggest thing that I need, budgeting versus results. And they say, I don't know about anyone else, but I don't find this hard or boring at all, because making money and learning how to do that effectively is a very high value to me.
Absolutely. And Jester was talking in the chat room a little bit about what it means to make money to Jester. Is that a man? I believe
I'm
it's a
not
guy.
sure.
He said, he was talking about how making money means that you can experience nice things, take care of your family, have those experiences. So it's not just all about the money, but it's also about the experiences that allows you. And we really are learning how to put that to best practices right here in this course. And we've mentioned it a couple times before. Along with the course, there's some terrific bonus materials that we don't want anybody to miss out on. And some of those with enrollment are available to you for free. So we highly encourage that you go in there and access those. The bonus that comes with purchase of the course, this course will normally be $149. However, it is available right now for the live discounted price of $99, and the bonus that comes with it is the entire keynote that you can access while you're watching the course. So as you go through each segment, you can also have the keynote presentation there with you, which is a very valuable asset to have as you go through this. And we've got Ken, this instructor here, who is very, very experienced within accounting and financial services and just small business guidance, really. So we've got a very experienced instructor right here at our fingertips. And we'd highly encourage you to at least go in and enroll. And if you'd like to, if you think this is something you'd like to have access to later on down the road, also purchase. And we will see everyone back in 45 minutes.
What's the play?
We're in way over our heads!
I can't figure this out.
With 35 years of experience,
Welcome back. If you're just joining us, we're entering into the last half of the final day of Small Business Finance Basics, QuickBooks, and Beyond with Ken Boyd. We had a great segment, this past segment, talking about cash flow. And this segment, we're going to get into transactions and using reports.
Right.
So we've got a lot to learn still. And I wanted to remind everybody that not only do we have the chat rooms for you to post questions and to have discussions, but we also are encouraging you to get on to Twitter, and you can hashtag BoydLive at CreativeLive and post any questions or comments you have there as well. And I'll let you go ahead and...
All right.
All right.
We're in the home stretch. Thank you, guys. What you'll see, we'll start with just a few slides on the screen. And this is the segment where I'm trying to go back into QuickBooks, and I'm going to do quite a bit more in this segment in QuickBooks. So we call it transaction and using reports. Now, there's been a lot of talk, not only in the room, but outside the room, that it's getting close to tax season. So obviously there are reports that you need for tax purposes. I'm actually going to jot a few things on the board for that one. I mentioned in prior sessions, are we calling them sessions, courses, or workshops? We had that discussion too. Documenting your process and training your staff. I can tell you that big companies neglect to do this. They either don't write down the procedures, or when they do write them down, they don't update them when they change. And when people leave your business, even if it's just, in your case, a freelancer, a part-time person who's helping you, that institutional knowledge going out the door is a problem if you haven't written down how you do things, because the person leaving may be the only person who knows how to do it. It's a big issue. Finally, we'll talk about using reports as well. So I'm going to start with a little bit on the board. And let me click to the next slide. So you got to do your tax return. Now, as mentioned before, most people in the audience probably are sole proprietors for the most part, okay? What's your accountant going to need? He's going to need the profit and loss, obviously, from your business. QuickBooks, again, calls it profit and loss, while accountants in the accountant world call it an income statement. So they're going to need that. If you have ownership, particularly with other people in a partnership, they're going to need to know who owns what. I'm going to get into that in just a minute. If dividends were paid, if it's a corporation, we're going to need to know about dividends, because dividend is a tax, what we call in accounting, a taxable event to the person getting the dividend. Number 3 adds on a little something else, which is for a sole proprietor or partnership, and I'm going to do this in a T account because I think it's a good explanation. Capital contributions, putting cash or equipment into the business. Share of profit and loss, which we, again, said can be uneven, and that was causing some confusion. The fact that in a partnership, the percentage of ownership or who puts in what into the business can be a different percentage combination than profit and loss. Your accountant needs that. Corporation, any additional shares that you issued, if you added on shareholders, dividends paid to shareholders. Okay? Let me just talk about, on the board first, this tax issue one more time because this gets a little complicated. And I think the way to do it is to put a personal 1040 form in the middle of the page like this. And I've mentioned before that there's a section on page 1 of a tax return that has income. So your accountant's going to need a few things. Many people in this audience may have a full-time job and get a W-2, but also do things on the side as freelancers. So you may have a W-2 for full-time work, F/T. You get a W-2, which has benefits taken out, and more importantly, taxes taken out, or more specifically, taxes withheld. W-2. You may have a 1099 if you work as a contract employer for somebody else. I get a lot of these. Again, 1099s, as we mentioned in a prior segment, do not have tax withholdings on them. No tax withheld. I'm abbreviating. And finally, for that individual business, for that business that you have, the profit and loss from your business, in this case, image photography, I'm going to abbreviate and I'm going to say image profit is going to be a line here on the first page of that 1040 tax return. So this number, the image profit, is going to come possibly from a QuickBooks Quick B P/L profit and loss. This is going to come when you generate at year end QuickBooks profit and loss. So that's what your accountant needs. W-2, 1099, the profit and loss from the business. And again, you need to consider your withholdings before year end. And this is one of the things that folks at Creative Live and I have been talking about during breaks occasionally, is this whole withholding issue. You need to plan this before year end. And the way to plan for it is have someone help you, an accountant preferably, but maybe somebody who's a business person, help you estimate your taxes. Now, there's two ways to handle the tax, gathering those tax dollars, if you will. One way is getting it withheld from a W-2, right here. The other way is to make estimated payments. So I'm going to say estimated taxes and payments. Now, I do understand that if you're in a cyclical business, and most of you are, where you get a big project, you have a dry spell, you're working like crazy, it may be difficult to estimate your revenue, which means it's going to be difficult to estimate your profit, and I get that. To the best of your ability, you want to estimate your taxes in these businesses, the 1099 work you do, and the image photography, the business that you do, because you need to make estimated payments for that income for which there is no withholding. You need to make estimated payments for the 1099 and the image photography income for which there is no withholding. Okay? stuff you need for your tax return. I'm going to switch gears and I'm going to talk about documenting the staff, documenting staff and the process of training people. Now, let me give you a good reason to document this. Let me give you a why I'm suggesting that you do this that's actually kind of exciting. Your process of doing things may be your secret sauce, the thing that you do so well or so uniquely that you can go out and make money from doing it. That might be your secret sauce. You have a better way of doing something than other people do. In the way you run your business, in the way you deliver your product and service. Now, we do understand that we've got to document records to train people, but a better reason may be we want to document records because this is the value of what you do. Using myself as an example, I found out after about a year of fiddling with it that the best way to teach people accounting is in Excel. So when I teach online on YouTube, all the videos that you see me do, other than the first ones that I did at the very beginning, are all driven by Excel. Because in Excel you can click around and see all the relationships. That's why I'm doing it on the whiteboard here, because you can see how things relate. So I guess maybe that's my secret sauce, that I do everything in Excel. There are college professors doing accounting in PowerPoint. That doesn't make any sense to me at all. You can't see how the numbers are connected. Is that my secret sauce? I don't know. I think that's an advantage. So I document how I do that to some extent. Yes?
So Ken, I have a question. Like when I first went into business and started my first company, I spent a lot of time studying like Toyota and process because I was doing a lot of manufacturing and creating textiles, etc. But one of the things that became important to me as my business grew was how to protect that quote unquote secret sauce. So when people are coming in and out, that secret sauce is not going out. And how do you do that?
Okay, good question. Hang on to that. Let me make one more point, and I'm going to comment on that. Let me do this. I'm going to call it procedures. So, and hold that, Jackie, just for a second before I lose my train on this one. How do you do it? You got to write it down in some type of document. We accountants love it if you have an operations manual. I don't care how you do it. Just write it down somewhere. Have a manual of how you do things. And if it's not a formalized manual, just have a document. So for example, it's been fascinating to be here at Creative Live. I was looking in the other studio where a class is going on, and they had that very unique camera that's on this long metal stand that you can move this way and up and down. Okay, there's got to be some training that goes on and involved in using that camera, because it looks like it's got to be really expensive. You don't want to whack it into something. So whether it's written down or not, there's got to be a process that you learn for handling that kind of unique camera. I thought it was kind of unique. It was unexpected. Okay? Now, so I'd like you to write down the procedure. And not only would I prefer if you write it down, as the procedure changes, work with whomever is doing that process to help them update that document. Oftentimes, people that are working for you change and improve what they do for you, but it never gets documented. Oh yeah, we've been doing it this new way for months. You need to document that. Okay? So document it and update it, which may include asking that person who's working with you, even a freelancer, hey, are you changing the way that you're doing this? Because a lot of it, we do things intuitively, and we don't write it down. So make sure it gets updated. Now let me address Jackie O's question, which is, how do I protect somebody from walking out the door with my secret sauce, essentially? One way to do it, and this is a question for an attorney, is to have people sign a non-disclosure document I mentioned the person who approached me who was starting an online education company, and I said, I want to see your business plan. And I said, I'll sign a non-disclosure document. I'm not going to steal your secret sauce, but I'd like to see your document. Because again, this is the skin in the game thing. I want to see if the guy's serious. It turned out he wouldn't send it to me. Maybe he's serious, I don't know, but he wouldn't send it to me. So a non-disclosure document. And again, this is a legal question, but this is a way of going to the freelancer that you hire, the part-timer, and saying, you know, you understand that this process is valuable to me and I don't want you to go steal it. It's perfectly reasonable. Another thing you have to remember, and I'm just going to go down this road just a couple of steps, is not every secret sauce can be protected legally. I'll tell you what I mean. I'm in a meeting with a group of people on Tuesdays where we're going through a process of writing very detailed, complex business plans. And one of the people in the meeting, there's 3 lawyers in the meeting with me, and the guy who sits next to me is a patent lawyer. So patents is the process of legally protecting something that's unique. So patent lawyers are all about things being unique. Okay? So there's a process of getting a patent. You need to talk to an attorney about it, which could be very expensive. Applying. Like many legal things, it takes a long time and it's expensive. But even if you go through that process, and you may talk to an intellectual property attorney who says, you know, what you're doing is not unique enough to be protectable, whether it's a copyright, trademark, patent, whatever. Even if it is something that can be protected, you then have to defend it. And here's what I mean by that. A good friend of mine came up with a slogan that a travel company uses and that all of you know. The problem is my friend came up with it first and was using it for a consulting business. And the big company that all of you know started using it, even though he had a patent on it and had filed the patent and had paid a lot of money, they started using it. So, and again, this is a question for an attorney, but in order to maintain the patent, if somebody starts infringing on it, you have to have an attorney approach them and ask them to stop using it, because if you don't, you end up losing the patent in so many words. So it's a very expensive process. And though, again, a lot of you are in technology fields, and you may be familiar with this issue. Not only do you have to file a patent, but you also have to defend a patent, which gets very expensive. Okay?
I think less expensive, you could do a cease and desist order or a letter.
Sure, and you could say, please stop using this. But if they just continue to, then, you know, the question is, how far are they willing to take it? So here's what happened to my friend. They started using his patented, I don't know if it was a copywritten or patented, I don't remember, slogan. And he asked them to stop, and they wouldn't. So he took them to court, and eventually what happened was he ended up settling and selling them the naming rights to the slogan that all of you know, and I'm not going to say on the air. But he ended up throwing in the towel and not defending it and just selling it to the people that wanted to use it. This is really expensive, really complicated. Just as a caution. All right? Now, why would it be valuable to protect your secret sauce? Because the secret sauce, again, may be the thing that gets investors and lenders and partners to fund your business. So you've got to make a decision through an attorney about how much of this do I want to do to protect my secret sauce. And that also has an impact on, can I go out and get investors and lenders and partners? Okay? My friend decided he could do business without owning that slogan. So he sold it. He sold it to him as a settlement. Okay? So the chart says the operations manual is how you do things. It documents your company's procedures. Why is it important? It allows you to think about your processes and consider improvements. By writing down a procedure, you may decide there's a better way to do it that you hadn't thought of until you actually invested the time to write it down. Explain your business to investors, lenders, and partners. I mean, it's clear from Creative Live that, again, part of the secret sauce is we do these things live, okay? Every company has that, thing that they promote. So now that we've talked about procedures generally, let me talk about a billing procedure. Oop, I went too far. And then I'm going to go do it in QuickBooks. One more. There we go. Bear with me. Yeah, I'm on the next slide. Okay. Billing. Billing procedure. And again, this so closely relates to cash flow, which we talked about in the last segment. You complete some photos for a client. You create a pre-numbered invoice for that client. Again, when I told the story of the fictitious payee and separating duties I mentioned, you as an owner need to control the invoices and they need to be numbered so you can account for all of them and find out where they are. You can create a pre-numbered invoice for a client using QuickBooks. We're going to create an invoice in a bit. You post an accounting entry. We've done this several times, so I'm not going to do it on the flipboard. You're going to debit accounts receivable. You're owed money. That's an asset. You're going to increase it. I send them all the Excel documents and an invoice electronically. Remind clients in the payment button on your home page. Client sends a check or pays via the pay button, and all that is written down. All of that is written down. Now again, tying it back to an entry that might be in QuickBooks, we then debit to increase cash, which is an asset, $200, and we credit to reduce the receivable, and the receivable goes away. Okay? Just a little warm-up to do a billing procedure. I'm going to switch, Ben or Brian, I'm going to switch over to QuickBooks, please. Thank you. All right. What we have not done, a few of the basics that we still have not done. We have not created an invoice specifically. And so what I'm going to do is, I'm going to go to Transactions, Sales. Let me do that again. Homepage, Transaction, Sale. New invoice. Let's just see what happens when I create an invoice. So, this is the invoice template. And again, I got there from Transactions, Sales. Here's your invoice. You'll notice, this is super cool, that the online payment ability is flipped on here for you, and you can work with your bank or PayPal or whomever to get that online payment thing set up. So I'm going to create an invoice. Let's talk about what's on here. I'm going to say it's Parkside Financial, 1313 Mockingbird Lane. You can see there's a spot where I can write in an email here. And remember that Sarah owns Image Photography, so that Sarah is doing some photography work for Parkside Financial. Okay? Billing address, let's look at terms. Josh pointed out earlier when we were looking at setting up billing for a customer that all of these choices just deal with when the bill is due. And what I mean by that is net 15 means it's due in 15 days, 30 days, 60 days. It does not relate to discounting. It does not relate to discounting, okay? So the due date here, if it's net 30, you'll see the bill is due in 30 days. If it's net 60, you'll see the bill is due in 60 days, which is in March. Does everybody see that change? 60 days is due in March. If I flip back, make it 15 days, it's due in early February. Does everybody see how I'm doing that? Okay. What did I sell? What did Image Photography sell Parkside? Well, you'll see here, and it's pretty cool, that because I picked a photography company when I set up QuickBooks, I have choices of products. We still, by the way, have over our mantle, we have pictures of our kids that were taken when they were like 5, 3, and 1. And when we take pictures as a family at Christmas, we stand in front of the picture of them when they were little kids. And I just noticed that it's a picture of all my kids today in front of a picture on the mantle, big picture over the fireplace when they were little. It's pretty cute. All right. I'm going to say it's event photography. So you're going to have a choice. Again, you can set up QuickBooks based on your industry, and one of the great things about that is you're going to have a choice as to what the product sold was. I'm going to say event photography. Here's another one of these instances where I would strongly encourage you, even though it's time consuming, to write in your own explanation. So I'm going to say Parkside anniversary event photos. Okay? By the way, it wasn't pointed out in my introduction, but I do have a face for radio. You probably didn't realize, maybe you do realize that. I thought I looked pretty old when I watched the clips from the first show. I think actually today I look 25 years younger. So I'm looking forward to seeing myself because I look pretty good today. Yes, the other day, not so much. I'm going to say quantity 1 because for these service things where you guys are doing a project, I don't think it's really necessary to put quantity down because you're doing one project. All right? There's a rate here. I'm just going to put the rate for the project. I'm going to say $500, 500, delete. And you'll see when I click over, it multiplies the quantity times the rate. So if I had sold 3 sets of pictures at 500, it would change to 1,500. You see that? It fills for you. So these autofill cells is both a blessing and a curse. It's great because it saves you time, but it's also, you got to be a little careful with it because these things autofill for you. Okay? Let's look at the bottom of the invoice. It says you can add lines if you wanted to add multiple services on the same invoice. For example, if the data from this invoice was coming from an estimate, you might want to put the estimate data down and go across and put a description and an amount so that the invoice detail ties to your estimate. Message. Thanks for your business. I always say that. Yes?
Is there a way to have like certain things like that you may want standardized in that message or statement memo automated?
And you would do that through the customer screen, yes. It's way, way down the list, but it's on the customer screen. Yeah, that would save time, wouldn't it? Okay. QuickBooks also has the ability, and it's beyond the ability of the online version to do statements. Now, let me make a distinction between an invoice and a statement. An invoice is a single piece of business that you did with somebody. You send them a bill. An invoice is a bill. A statement, on the other hand, is when you send somebody a statement that shows all the business that they've done. So if we went to Parkside Financial 5 times in 1 month, and we send them a month-end statement, here's the 5 things that we did for you, the 5 invoices, you've paid 2 of them, you owe us for 3 of them, and here's the total. Don't be confused when you get paperwork, whether it's hard copy or electronic, between a statement and an invoice. I don't want the people at Parkside to think that I'm rebilling them for 5 jobs. It's not a bill, it's a statement. Okay? You can, and this is cool too, you can put an attachment here if you want to. Save and send. Now, it would send it to the email address you put in, okay? Save and send. Since I don't have an email address, I'm just going to put save and close. So it says, because this is the second invoice that I did, that it's invoice 1002 and it's saved. And I like that after you click and that it gives you that big confirmation that comes up on the top of the screen. Now, if you're like me and you're paranoid, by the way, I'm not paranoid if people are following me. Then I'm not paranoid. Not paranoid, people are following me. So, recent transactions, there's the invoice. Okay? Now, once I hit click and it posted, look where it takes me. It takes me back to the sales transactions screen. Remember, transactions, sales, that's where I am. And it shows these invoices down here. And it shows in red the status that they're open, which means they have not been paid. Okay? Questions on creating a basic invoice before I go on? Okay? Now, we're going to pay and we're going to have an invoice be paid here in a minute. However, you will note, yes, go ahead, Josh.
Batch actions.
That's the next thing I was going to say.
Oh, okay.
You're reading my mail, as they say. Let's assume that 5 invoices down here are from the same client, and they send you one check to pay 5 invoices. You can use this batch capability where you can check 5 of the Parkside invoices and mark them all as paid all at once with a single check. Okay? Receive payment. Print, send, packing slip, copy. You've got some choices there in terms of a payment being received. Now, I'm going to go into a different way and pay one. A little bit down, yes?
Well, you're going to be sitting at home and a check's going to come in the mail and you're going to see who it's from. Mm-hmm. And you have to match that check up to this invoice. Isn't there an easier way than, I mean, how would you do that?
There's really not an easier way. Unfortunately, whether it's a check you get in the mail or an electronic payment, you're still going to have to take Parkside sending me let's say Parkside sent me $1,000. I'm going to have to go into my invoices.
You can't just look up Parkside and then have it refer you to this invoice?
Yeah, let me hold that thought for just a minute. Okay. There's a couple ways to do it. One way, and I think frankly the easier way, you could go into this screen and see what Parkside owes you, and if it's a check for $1,000 and there's 2 open invoices for $500, you click on them and you get them paid. The other way to do it, as you just said, let's go to the customer window. And this says Parkside has an invoice and they owe us $500. If you want to go it that way, you can do it that way. That might be quicker, wouldn't it? Go to the client rather than look at a string of invoices. It's probably better. So, let me just restate that before I lose that thought. There's 2 ways to pay an invoice, which is what we're going to do in a minute. In fact, here's what I'll do. I'm going to pay one of them from this screen, and then I'm going to pay the other one from the customer screen. Okay? So I'm going to check on the invoice that got paid, and I'm going to hit receive payment. Let's see what happens. A screen comes up that says receive payment. Is everybody with me? I clicked a box. I said receive payment. I'm going to go back. I checked a box. I'm in transaction sales. Click. Receive payment. Action. You with me? Everybody with me?
I'm not with you.
Okay.
So what if you don't check the box and you just click receive payment? Why are you checking the box? What is that?
Because if you don't check the box, it just goes to the first invoice on the list.
Oh, okay.
Okay? If I click the second one, and I hit receive, which is for Riverside, it goes to Riverside's invoice. If I don't click the box, it just goes to the first invoice on the screen. Okay? Nothing's checked.
Well, what if you go down and
Okay,
click?
let's see what that. Yeah, now you're testing me. I'm not sure. Oh, okay. Don't have to check the box.
So what's
Cool.
the box for?
Checking multiple. It's for the batch feature, so you can
okay.
check multiple.
Oh, I see.
Okay.
Got it.
All right? There's going to be a test. What if I fail my own test? Ooh. I'm not going to print the results. On the Facebook page where everybody's thanking me, I'm going to put at the bottom, everyone should know that I failed my own test.
So if you click the top box, both of those will come up?
No, let's do it. This box?
Down. Yeah.
That one?
Yeah, what's
that?
that?
Would check all the invoices and you would pay all of them. Now the problem is, you could do that. That actually brings up a good point. Let's say that I got checks in from both clients. You could check the top box, which would click both invoices and pay them. I wouldn't suggest that. I would suggest paying them separately.
So you would click, what if you clicked receive payment now after that?
All right, let's just see what happens. It goes to the first one on the list. Yeah, well, here's what I'm getting at, and this brings up a good point. It is very easy, particularly in a business where you have lots of small transactions. It's very easily to mess up the check that came in and which invoice it paid. Now, one thing to do when you create an invoice is to ask your client to write the invoice number on the check they send you, or to write it in the memo field if they pay it through PayPal. I'm paying invoice number 123. Because this gets out of whack very easily. Particularly if you sell a lot of a product to multiple clients and it's all the same cost, sales amount. So you've got 16 invoices out for the same $500 amount. It gets really complex. It's easy to mess up. Mm-hmm.
What if you get a check-in and part of it is for an invoice and another part of it is for a deposit? So you get a check for $1,000 from Parkside and $500 is to go to invoice 1002 and the other part is deposit for something in the future.
Mm-hmm. What I would do, that's complicated. There's a couple ways to do it. What I would do is create, let me think. For the amount that's a deposit, say 500's for a current, they're paying, let's say it's Parkside and they're paying this invoice with 500. 500 is a deposit for another job. I would create I would create an estimate for the job that you got a deposit for. Now again, I'm not real big on using estimates because people confuse them with invoices, but I would create an estimate for the deposit, and then you can apply the deposit to the estimate and the other part of the cash that came in to the invoice. It's a little complex. That way, because the other way would be to make a journal entry, but that's the better way. You got an invoice and you got an estimate and they add up to $1,000. Okay? Okay. Receiving a payment. Parkside Financial. The date that they're paying today. Payment method. I'm going to say check. Reference number. You'll note that down here they tell you what the invoice number is that they have outstanding. Now, it's possible, as the example that Jackie O just said, that the check that you get does not match up with the dollar amount of the invoice because they're sending in a deposit, or they could be paying multiple invoices. That's possible. So reference number, invoice 1001, excuse me. Now, the reason I hit checking is I'm going to put this in the checking account as a deposit. Amount to apply, Jackie, here's where here's another way you can handle the deposit. If it was a $1,000 deposit, you could pay $500 on the invoice and give them a credit of $500. I'd rather have you do an estimate because having that credit on the client's account gets a little tricky too. I think the best way is to do an estimate and put it into undeposited funds, as we talked about yesterday. Unearned revenue, customer deposit. Put it in unearned revenue, customer deposit, okay? So, receive payment, we're paying invoice 1,002. I'm gonna apply the $500 check to the $500 invoice. I'm gonna hit save and close. You'll note that the invoice is now coded as paid, yes.
So I have another question with QuickBook in relationship to cash payments. I don't deal with cash too much at all, but I do have friends who have businesses that handle like a lot of cash. And when you're doing your books and you're actually projecting out or thinking how often you should do deposits, thinking also in line of protecting yourself because cash can disappear quickly. Like, do you have any advice or tips for people who deal in a lot of cash?
Yeah, let me write on the board. Good question. Which reminds me, I did some work for a nonprofit one time that had it was for a sculpture park in St. Louis, and they had an annual art show. And their procedures weren't in good order. What they were supposed to do was to have a drop box. So one of the things on controlling cash is to have the ability to have a night drop so you can deposit cash 24 hours a day in a drop box, secured drop box. The sculpture park's drop box was a slot about that big, and I had $15,000, so I slept at home with $15,000 in my bedroom. That's less than ideal, okay? You gotta have a drop box. All right, let's talk about, let's take this a little bit further. Do they have is this a retail shop?
Yes.
Okay. And they have an employee?
Yes.
Okay, so here's a procedure. You give them, and you see this, again, I spent my whole life working in Panera. You give them a cash drawer with a certain amount of cash and denominations in it, right? Let's say it's a total of $500, beginning of the day, when you open. You do sales during the day. You then take your changes in cash, your sales, which is going to be deposits, abbreviated, any returns, which would probably be one of the only reasons they'd pay somebody cash, is a return. And you're going to agree that information to the point of sale system in the cash register. Do they have an automated cash register? Everybody, just about everybody does. Let's say that $1,000 came in and they had a $50 return, okay? So that means that's an increase of $950. Then at the end of the day, or when that employee leaves, you're going to do, the owner with the employee there, are going to do a cash count. And they need to come up with 500 plus 950, which is 1450 in cash. Another thing I would do is to minimize the amount of cash, physical cash you have there. So if you think you need $700 cash for the day, just keep $700. If you run low, you can always send somebody to the bank. Have a drop box to put the money in. If it's a small business, I would only have the owner do the drop box. Only have the owner physically take the cash. Now, I know lots of small businesses where the owner takes the cash out, fills out a deposit slip, Staff person goes to the bank, brings back the deposit slip stamped that it got deposited. I'm okay with that if you know, if you're a reliable employee, you think. I prefer that the owner do it. On the way home. Put the money in the drop box. You got a deposit slip, all the money, it's a locked bag, you throw it in the drop box. Okay? Yeah, so having your accountant sleep in his bedroom with 15 grand in cash, that would not be a good procedure, but it happened. So what we just saw was we recorded an invoice as paid, and it was paid by check. Okay? So that is creating an invoice and paying an invoice by check. Brian, if I could get some water. I know you're out of the room, but you got a headphone set on. Expenses. Let's pay an expense by check. Let's create a new expense. You can see when I pull up expense transactions, I've got a check that I wrote to Reliable Technology that's a vendor, told me what category the expense was, and the total was $100. I had another expense down here for mobile gas station that was cash for $20, okay? I made a mistake here and I tried to set up a credit card. Oh, thanks a lot. Thank you very much. I tried to set up a credit card transaction and I didn't do it right. That's why this is here, and I don't want to take the time to remove it. Thank you very much. So let's create a new transaction. And let's create a transaction that I pay by check, because where I'm going is toward handling cash here in a minute. You'll notice check number 2. Let me do that again, because I'm not sure everybody got that. So I'm in transactions expense. Everybody see it? Down the left. I'm going to create a new transaction. I have a choice. I can create it by expense. I can just say expense, or I can write a check. I'm going to write a check. I click on it. It tells me it's check number 2. Conveniently, it tells me my cash balance at the top. What vendor am I paying? Let's say I'm paying let's pick a different one. Sunset Photo Supply. It's coming out of the checking account. Now, the reason I keep saying checking account is you could, under the cash heading in Excel, we're not teaching Excel. This is an Excel. Oh my gosh, this is not Excel. Under here, I've only got one account for cash. It's checking. You may have multiple accounts for cash. In nonprofit world, often a requirement of restricted funds is it has to be in its own account. You could have multiple checking accounts. You'll notice when I put in Sunset that the mailing address filled, the date of the expense is already there. Okay? Yes?
So can I have a question? Do you recommend multiple accounts? Because I have a friend who's an interior designer, and each time she gets a new client, she opens up a new bank account where they put their deposit in. And I think that's a little tedious, but she thinks that that's the best accounting practice for her. So what do you recommend?
I would strongly advise against that. I would have one account, because that every time you add a client that's a new bank account, you got to reconcile, and then there's also the risk that you deposit client A's account and client B's account. I think if you're careful with your accounting, you only need one bank account. I really do. I really do. Okay? Account. What happens if I click on that? Well, what comes up here is the expense account that this check that I'm writing should relate to. Now, Sunset Photography Supply, let's go down to expenses and see for a photography company what QuickBooks has. I could call it job materials right there, for example. Photography processing, I think, is the one I used before, maybe. I'm going to click on that one. And I'm going to say processing cost for Parkside Financial Parkside Photos. Make it easy. Okay? And I'm going to say the amount is $75. Now, again, just like you can have multiple lines for the invoice, you can have multiple lines for the expenses too that you're paying. I'm going to hit save and close. Everybody all right with that before I hit it? One other thing. Again, there's a memo item down here if you want to add it for your own purposes. To go with that check, this is like the memo line. If you write a physical check, you have a memo line. Okay? So I'm going to hit save and close. So now what happens when I do that, if I have an expense, that expense for check number 2 gets added in this line right here. Okay? You'll see that Transactions does have the ability to print checks, and what it's going to do is give you the setup system for printing your checks. It's become much better, easier on QuickBooks to do this. If you print physical checks, you just put the check stock in your computer and you can print off your checks, and it has a procedure for how you do that right here. You can print this off. You can print these instructions off to print your checks, okay? Everybody okay with that? Okay? So what we've done so far is we created an invoice. Oh, I'm sorry. I'm in the wrong place. Sales. Transaction sales. Create an invoice. We had some expenses. We printed some checks. We showed you where to print checks, okay? Let's go back up to home, because I want to make sure before I get too far gone here that I make sure I've looked at all these. I'm going to do more on these down the vertical, but I want to make sure that I've got stuff across the horizontal covered here. Excuse me, about ready to sneeze. Budgeting, we've talked about budgeting a couple times. You'll see that arrow. Pardon me. So thank you. It says you need the upgraded version of QuickBooks Online to create budgets, but that is out there if you want to use the updated version. Just to make sure I touch on everything here.
Did we look at batch actions at all?
Let me go back to that. Actually, Christine, could you save that? And I'll get back to that. Just remind me that in a minute here. Again, there may be situations where you have to export data out of QuickBooks. It gives you instructions on how to do that. You may have to export data. You can export it into Excel very easily. QuickBooks is easy to export to Excel if you want to do that. Okay, budgeting we talked about. Yes, ma'am.
How can QuickBooks help you if you get audited?
Okay, let's talk about an audit. Excuse me. That's a good question. Like a tax audit, you mean, right? Okay.
Exactly.
There are two groups of people who are both educated and also, to a certain extent, obligated to represent you if you have an audit. So CPAs, certified public accountants, and another group of people called enrolled agents. Enrolled agents pass an exam to become tax preparers. To a certain extent, and again, you need to check with a CPA or an enrolled agent yourself, these people have an obligation to represent you if you're audited on a return that they prepared. Now, let's imagine that image photography you look at their income statement, which is what they're going to look at, because it's all about the profit of the business that they're auditing, has revenue, expenses, QuickBooks is going to show those numbers. So let's say it's an audit of your 2013 taxes. So you go into QuickBooks, Reports, Profit and Loss, and you would essentially print off for the entire year. You can see in the drop-down, you can do this year. You print off your profit and loss. Now, here's the thing that is more, and I'm going to look at QuickBooks here. Here's the thing that's more your responsibility than the accountant's responsibility. And your responsibility is to be able to have the documentation to prove not so much the income, but to prove that these expenses are legitimate. So you need to keep all these receipts on file, essentially. Because obviously what a tax audit is about is your income too low, which means your expenses are too high. So they're going to look at these expense numbers. They're more concerned about expenses being too low than they are about you understating your income. They're more about expenses. However, well, let me back up. So for expenses, you need to keep the receipts. The depreciation, I would check with the accountant and make sure you're using the correct number of years. I keep my receipts from my insurance premiums that I pay. You're also going to have your checkbook. This is another reason to reconcile your bank account. So you're on top of, so if you need to, you can hand them your bank statement, which is all business and not personal, and go through it and say, here's each one of those transactions that you see in QuickBooks, and the two agree. On sales, you can take the sales that make up your total sales, here in this case it's 720, and you say, here's all the invoices, and if you look at my checking account, here's all the deposits. And now you've essentially proven your income. I mean, you've proven your income and expense, which gets you down to your profit. Is that okay? Okay. Okay. Continuing across the top, just to make sure I caught everything, I'm going to do reconcile in a minute. Again, when I go to create the plus button at the top, I'm only getting initially four things. Let's create an estimate. We've talked about estimates several times. All right? Let's create an estimate. Again, this relates to the job costing that I talked about earlier today. So it's an estimate for Riverside. There's their address, the date of the estimate. You could have an expiration date which essentially says it's been so long since I did the estimate, the numbers are no longer valid. You could have that. I'm going to keep it really simple. I'm going to say that the thing I'm estimating is event photography. Oops, sorry. My watch is beeping. Estimate for July opening. So you're going to shoot pictures for their reopening of the store, yes.
So Ken, would you put the estimate together with the contract, or are you sending these things out separate, together? How would that work?
As long as the estimate that you create in QuickBooks has enough detail to meet your needs, that is, it has enough lines on it, it has the amounts on it, you could just send the QuickBooks if you wanted to. Yeah. So I'm going to say the project's $700. So what I've done is I created an estimate for Riverside. Here's their billing address, the date of the estimate, the fact that what I'm doing is event photography, and the description of what I'm proposing to do, and the total estimate. If I click out of it, you see the $700 fills. Again, you can have a memo section on here. Now, You also have the choice to do save and send. I put a fictional email address in here, so if I said save and send, it would jump over to the web and send it. I'm going to hit save and close. Estimate 101 saved. There's my reminder. If I click on the home button and I go to the circle here, for my recent transactions, I see the estimate here that I did that transaction. So I actually did what I wanted to do. Okay? Now, what we just did there is we created an estimate. What if I just click on create, again, I'm on the X, create estimate again. It comes up with estimate, just the template. In other words, it does not go get that estimate, a list of those estimates I already created. So, again, one more time, estimate, create estimate. Now, let's go back to transactions, sales, and what I'm trying to get to is I'd like to take that estimate and create an invoice with it, which is very common. If you look under sales transactions, what you see is that it lists both estimates and invoices. You see that? I have the two invoices I've already created, and then I have an estimate here. Okay? And it says status pending, which means I haven't even invoiced the client yet. So look at the status to keep this straight. Pending means I haven't invoiced them. Open means I've invoiced them and they haven't paid me. And finally, paid means they've paid me. See the difference? So I'm going to click on this estimate and I'm going to say start invoice. The great thing about this is all the estimate data flipped right over into an invoice. So now all I really have to change, assuming that all the numbers stayed the same, that the amount stayed the same, was to change the description to, for example, July opening invoice. So I've taken an estimate, I'm now creating an invoice. Okay? You'll also see up here it says one linked transaction because the estimate is linked to the invoice. So I'm going to hit, is there any questions on that? I'm going to hit save and close. So look what happened. The estimate is now closed because I used it to create an invoice, which is now invoice number 1003. The estimate closed, the invoice has now been created. You'll also see across the top, under sales transactions, there are no estimates existing anymore where it says unbilled, 0 estimates, and $0. This is really handy because it shows you your unbilled, which would be the dollar amount of your estimates, unpaid, people I've invoiced that haven't paid me, who's paid me within the last 30 days. Yes, Renee.
Would you be able to later use that estimate, just copy and paste it?
I believe you can go out and get old estimates. Yeah, let's click on it. Yeah, you can. And you could basically there's a way to do that, yes. Save and new. You do save and new.
How about just try changing the name?
Well, I think,
Is
Renee,
it
what you're getting at is you want the same estimate for the same client?
for a different client?
For a different client, maybe.
Oh, use the template? Okay, yeah. Riverside. Let's say it's still event photography, but this time it's an estimate for spring party. I can change the amount. Pardon?
It still says that your invoice is closed, so that might not work.
Well, here's what I'm gonna do. And Candace says, well, it still says, say that again, I'm sorry.
It's still saying that your invoice is closed, like you're editing the original document.
Right. Let's see what happens when I hit save and new. Your transaction is edited as linked to others. So I guess, a long story short, Renee, it's probably better to create a new invoice, a new estimate, because you'll see that all it takes is filling in a client. The billing address fills automatically, picking the product or service, event photography. So it's not too much work to go in there and create a new one from scratch.
Okay.
Now, by the way, on more sophisticated versions of QuickBooks, you can put your logo on there. I mean, you can make it look really nice. I know you guys are in creative fields. You can make it look a lot better. Okay? The reason, and what I wanted to do in this segment before I got too far gone, was the reason I created some checks is so that I can go to banking. Let's go to banking. We haven't done that yet. We haven't done it in this segment. So I get rid of that. And I get this thing that says accepted and unaccepted downloadable transactions. So my point here is that if you want to reconcile your bank account, going to transactions banking is not the path you go to reconcile, okay? Instead, home plus show more where was it? Am I in the wrong place? Bank deposit. I'm in the wrong place. Let me click out of this. Wheel. Reconcile. Everybody see it? Wheel. Let's see what happens when I hit reconcile. Okay? So it says there is no reconciliation history to search since it hasn't been reconciled before. This is the first month the account was opened, because this is the first month the company's in business. That's important because if you've got transactions from past months, you want to pull that into your bank reconciliation, obviously. Outstanding checks from past months, deposits that you posted on December 31st that didn't hit the bank until January, and now you're reconciling January, okay? Please note, because Jackie O mentioned she had the friend with multiple checking accounts. Which account are you reconciling? I've only got checking. So, again, I went to the wheel and I went to reconcile. Is everybody all right? Reconcile now. I wonder what will happen. Okay, start reconciling. It asks me to do a couple of things. And what it's asking me to do is to enter information from my bank statement that may not be in my accounting records yet. Okay? 2 listed here. Enter the following information from your statement. The statement ending date, January 31st. I may get it. No, I won't get an error message because it doesn't know that I'm not to the end of January yet. Beginning balance, I'm going to put 0. We didn't have any money in the business until we made that transaction to fund the business in January. Ending balance. I'm going to put a number in there because I think it's going to force me to. So what am I doing? I'm taking a look at the bank statement. The ending date is 1/31, the end of the month. I didn't have any beginning balance for January. I'm going to put in an ending balance that's on the bank statement. Okay? Service charges and interest earned, if any. Well, let's just put something in. $5 on January 31st, and we're going to call it a bank charge. I earned $20 interest. I recorded it in my accounting records, it was recorded in my bank statement on 1/31, interest earned. The point here being, these 2 transactions right here may not be recorded in your accounting records. You may not record them until you get the bank statement from the bank. Okay? So, we're reconciling the checking account. 12/31 is the ending date of the statement. The ending balance, and this is different from the ending balance we have on the books, okay? Just to let you know. I had a $5 service charge on the 31st. I may not have recorded in my... It's okay if you guys don't want to record these charges until you reconcile your account. That's okay. I'd prefer that you try to record them sooner than later. If you know you got a bank charge coming for the month.
It's dollars, not percent, right?
Yes,
Okay.
dollars, dollars, dollars. It does not have a dollar sign, I understand. So, if you know this is coming, if you know you're going to get a $5 bank charge, I'd prefer that you enter it into QuickBooks before you do your bank statement. If you know you're going to earn 20 bucks, I'd prefer you put it in your QuickBooks as a journal entry before you get your bank statement. You see what I mean? I would not wait for the bank statement if you can help it. Just get it done sooner. What if I hit OK? Here's what happens. And this is the great thing about QuickBooks, I think. We've got checks and payments here on the left. We've got deposits and credits here on the right. Okay? Checks and payments outgoing on the left. Deposits on the right. Now, you have the main part of your reconciliation down here at the bottom, which reconciles from the books, what you have in QuickBooks, to the bank. Okay? Now, I've got a big, monstrous difference between what the QuickBooks says and what the bank says, because what I did was I loaded in a statement that said $5,000 as an ending balance. One check, one deposit. I've got a big difference here of $49.85. Okay? It's not perfect, but what I want to explain without doing it perfectly is when you get your bank statement, you're going to look at the bank statement and your QuickBooks is provided for you, and you're going to start clicking off the things that posted to the bank statement like this. Okay? I'm just going to say everything clear just to make it easy. Now, you can see that even with everything clearing, I still have a difference between the ending balance on the bank statement, $5,000, and what they call the cleared balance, which is what's in my accounting records in QuickBooks that's clear. That is, it's on the bank statement. My QuickBook balance, if you will, assuming that everything cleared, is $1,350 lower than the bank statement because I just made up the number. What happens when I hit Finish Now? It says there is a difference of $1,350, and it gives you some heads up here. Between the total of the selected transactions, remember I cleared everything, and the ending balance. What could it be? Click Add Adjustment to enter the adjusted account balance. The adjustment will be posted to the reconciliation discrepancies, or cancel to return without making an adjustment. Okay? Let me read it one more time. Click Add Adjustment to adjust the account balance. The adjustment will be posted to the reconciliation discrepancies, or cancel to return without making an adjustment. What I would suggest you do is, well, let me hit Add Adjustment. See what happens. Okay? It takes me to a screen that says, here's my, for the month ending January 31st, and reconciled today. I'm assuming I wouldn't do any business for the next 7 days. The ending balance in my checkbook is $1,350 difference than the ending balance on my bank statement. Checkbook is $1,350 different from what's on the bank statement, okay? This auto adjustment is the difference between what we call in accounting the bank balance and the book balance. What if I click on it? It gives me essentially my bank reconciliation, okay? A lot of detail there. You can print it if you want. Again, you may want to print this and file it so that if there is an audit or if you want to show your financial records to a potential investor, you've got a hard copy of the bank rec, and you can have the bank statement and the bank reconciliation all in one, okay? What if I scroll down? That's about it. So, what I did was I reconciled the bank statement. I have an adjustment of $1,350 that's hanging out there unresolved. And if you go to recent transactions, it says deposit adjustment $1,350, which is saying to Image Photography, the bank says you've got $1,350 more dollars than you think you do. So let's click on the adjustment. The system assumes that if your QuickBooks are too low, you must be missing a deposit. Let's say we are missing a deposit, because I want to post the adjustment and see what happens. Okay, one more time. The QuickBooks system assumes that there's a deposit that you're missing because the bank says you're $1,350 too low after reconciling. You follow me? Okay. So I'm going to say that I missed a payment from Parkside. The account it goes into is going to be an income account called sales. It was for the January party. They sent me a check, and it's for $1,350, okay? And it says, if I slide down, the memo says reconcile an adjustment, and I'm going to say customer deposit not posted to accounting records. Just to remind myself, okay? What is this? Cash back goes to, cash back memo. None of it involved cash. Specifically, it was a check. You've got some other memos. You've got an attachment you can do down here, blah, blah, blah. Let's do save and close and see what happens. So we have a deposit adjustment. Now, what it's going to do is it's going to ask you to reconcile all over again. Now that you have that correction made, it'll all work out. Okay? Once you've made the adjustment for the thing that you missed, it'll all work out. Okay? I'm not going to go through the whole thing again, but to give you some idea. So let me say a couple things on cash again. Reconcile your bank account within 5 days of the bank statement. Please do put your cash activity in QuickBooks. If you reconcile and you have an error, go ahead and run the adjustment like I did and click, yeah, keep the adjustment. That amount will sit there and your bank account will be unreconciled until you fix it. So it'll be isolated there until you fix it. Now, one more thing. You will not be able, I don't believe, to reconcile February until you get January fixed, which is good. You don't want to go into the next month and try to reconcile until you get the other month fixed. I am aware of a situation where a fairly large discount store that's in the South, and you would know the name. Some friends of mine who worked in retail at Macy's went down there to be their accountants. They had a $1 million unreconciled difference in cash. $1 million that they had blown off and hadn't found the difference for. $1 million difference in cash. I say that because this process of reconciling, it's tedious, it requires focus, it can get away from you very, very quickly. The horse can get out of the barn, and this thing can get away from you very quickly, and suddenly it's 3 months down the road, and you have no idea what's going on in your cash account. And I am pleading with you not to do that. All right? Questions on that? Okay? I'm going to go on and do one more thing in this segment. Bear with me just 1 minute. Ben or Brian, we can switch back to the main course screen if you like. That would be great. Let me talk about, to wrap this up, because in the last segment I'm going to do decision making. I want to just walk through the types of procedures that you might have, because we've talked about a few of them already. We already talked about a billing procedure. Got to have a procedure for how you bill people. Estimates, invoices, send the estimate, how you get the check back, how you make a deposit, how it goes back electronically. You need a process for handling cash, like the retailer that Jackie O brought up, which I consider a separate issue from billing. That's a procedure. Candace reminds me that you got to have a procedure for handling inventory. Who has access to it? Who sends it out? How do we track, what got sent out? Which inventory item was sent? What was the cost? You got to have all that. You got to have all that. So you need a procedure for inventory. Why? These are assets you use to run your business. You don't want to lose them, whether it's through your own mistake or through theft. You want a procedure for that. Seems like 100 years ago, but I think it was yesterday somebody brought up purchases and purchase orders. You got to have a purchasing procedure where you create a purchase order and then somebody approves it, an owner preferably. And then we place the order. We receive the goods. And we want to make sure that what we received is what we order. Remember the example I did on theft using purchasing, that you got to make sure that if you have a restaurant and you order meat and fish, that the meat and fish actually got there and it matches what you put on the invoice, the order you placed, and it also matches what got approved to be purchased. All that needs to match. And then you got a procedure for writing a check. These are the biggies. It's a hassle. It's time consuming. You're not making any money writing procedures, but these are the biggies. These are the biggies you need. Okay? Very important procedures, because what I'm trying to get across is as that business grows, which is the first thing I said in this course, before things get out of control, please write down some procedures. Any questions on that? Okay? Procedures. I am going to set up, believe it or not, the last segment of this course. What? It can't be possible. I'm going to set it up here. This is all about decisions. I mentioned in class before, if you look at any accounting textbook, it usually has the word decisions somewhere in the title. Okay? The reason I stood up here and you had to look at my ugly mug for 3 days is because I wanted you to be able to make better decisions. So we're going to get to some decision making in the next segment. Now I'm going to mention just a couple of them, and there's a whole bunch more that I'm going to go through that I have additionally from the table of contents from my book, okay? I'm going to put some on the board here that are from the book that are in addition to the slide deck, and I just want to mention a few of them before time gets away from me here. Excuse me. We did job costing, and we did assigning costs and making sure that you assign costs correctly. We did that. That's kind of a decision, but I'm going to do some more. I am going to do something called the inventory formula, which helps you think about your inventory balance and purchases and what you sold and tying all that together. So we're going to do inventory formula in the next segment. And bear with me because there's a few of these that I want to pull up before I lose my train of thought. We talked about overhead, which is another way of saying indirect costs, and how we assign overhead. Maybe you add it as a markup in estimates that you do and in your invoice. Maybe it's a separate line item that says overhead. We talked about that. We're going to talk about the concept of relevance. That's the who cares. Relevance. And we're also going to talk about cost versus benefit, the cost of getting information versus the benefit that it gives you. Very important in accounting world. Relevance. Not everything's relevant. Not everything is worth you spending your time on. Okay? I'm going to do some more stuff on pricing. And I'm going to talk about something called product life cycle. Many of you who are in creative fields, you deal with technology, and technology changes rapidly, which means the product and service that you deliver changes all the time. I'm going to do something on product life cycle. And the rest of it I will leave for the exciting, never a dull moment, last segment of the, what am I going to do Saturday? What am I going to do Saturday? So I'm just going to be wandering around San Francisco just looking at people and trying to explain stuff to them on Saturday because I'm so used to this. So the last segment is better decisions through accounting. Any other questions from our host?
No, I think we're all good on the questions here. The one question you may be asking is, what did I do with Evie? She is no longer up here, but Evie was not feeling well. She did have to step out, but the show does go on, so we will be going into the final segment, as Ken just mentioned. And if we don't have any other questions from the studio, we're going to move right into it. So Ken, you already explained a bit what we're going to be doing in the final segment of the course, so I do want to read a few quotes before we do head to our final break. As we've been mentioning, the Facebook thank you card for Ken is up. You can go leave your comments there. As we head into the final segment, we will be reading any that you've come across and anything that you want to share with the whole audience out there, what you thought of Ken, and your chance to leave him some appreciation. So I do want to share a few that we already have on there. Danielle Splatt says, great course, the practice with journal entries, both within and outside of QuickBooks, and the part about segregation of duties were the best takeaways for me. And then Janine Davis says, the content you are sharing has been fabulous, so thank you very much. And you know, we've made no secret that for a lot of you creative professionals out there, accounting and finances are not your favorite thing. You may have been neglecting them, you may have been putting them off for a long time, but now is the time to really improve them. And I think that based on these comments we've been seeing on Facebook, a lot of you out there have really appreciated the way that Ken has kind of made this fun. We've been telling a lot of stories, we've been joking around. It can be a light topic, we can take this and make it applicable for everybody out there, no matter what your businesses are. So we appreciate all of the wonderful feedback. And this information, it's vital to everyone's business, and it's a difficult thing to come by. There are books out there, there are college courses, but we've condensed so much material in only 3 days here. And the best thing about it is that it's very flexible for you guys and how you want to use it. That's the beauty of purchasing this course, is you will have all of the video segments to pause, rewind, and learn at your own pleasure whenever you need the information. So this course does normally cost $149, but as we head into the last segment, you can get all of it for $99, and that does include the bonus materials that Ken spoke about, free with enrollment, the list of the books that he recommends, as well as all the formulas we've been talking about, so you have them in one easy-to-read place, and you will have access to all of the slides that we've seen throughout the past 3 days. So it's a great value for you guys to sort of condense all of this material that we've covered in 3 days into a time frame that works for you. So as we head to the final segment, check it out, and we will be back here in 15 minutes.
I'm learning to tell better stories.
I'm learning how to manage 200 emails a day.
I'm learning how to get my
Welcome back to Creative Live. This is Small Business Finance Basics, QuickBooks, and Beyond with Ken Boyd. Hard to believe, Ken, this is the final segment of the 3-day workshop.
It's hard to believe we got this far.
Oh, I know, right? It's been a journey. It has been a wonderful 3 days. And throughout the course of the past couple days, someone has been mentioned in a few of your stories. The famous Mrs. Boyd has come up in a number of stories. Yes. And we are actually fortunate enough to have Mrs. Boyd in the studio with us for this final segment.
Yes, my wife Patty is here in town, and we're going to have a great weekend in San Francisco together.
Yeah? All right. So, yes, without further ado, I will let you get to the final segment. I know you'll be on your best behavior with Mrs. Boyd here in the studio with us.
Yes.
All right, take it away.
Thank you. All right, thanks everybody. I'm going to go to about 3 slides, and then I'm going to do the rest on the board here. So I mentioned before the break that this is about making business decisions. In fact, my whole reason for being here was not just QuickBooks and accounting, but more broadly to help you make business decisions. So the purpose of the segment is using accounting to make decisions, and I've got 4 decisions that are mentioned here on the board that I'm going to do first. I've got 3 that I put on the easel at the end of the last segment that I'll do after that, and then I'm just going to keep going and going until I just drop at the end of this every business decision idea I can. Okay? So that's where we're headed. The first, I think, is very applicable to the creative audience, which is a make versus buy decision. Should I make a product or service myself, or should I purchase it from a vendor? Now, we've had a lot of discussion about those of you who go out and hire people to help you do things. And I use the example of Christine hiring production people, or it might be Candace goes out and hires somebody to help sell her product. Whatever it might be. You've got a decision to make on make versus buy decision. Is it cheap? There's 2 parts to the decision. What's the cost of doing it yourself versus buying it? That's one decision. And the second decision is, what about quality? What about timeliness of an employee, quality of the product, etc. So there are economic decisions. Is it cheaper to make it or buy it? And then there are non-economic decisions like the quality of the product or service depending on your decision, okay? So first of all, what information do you need to make the decision? And this is a big one. The second line there, fixed costs are ignored and not included in your decision. If you go back to the example that I did on the airline, where I said, I'm running to the gate to buy a ticket. And I said that all those costs, almost all the costs that the airline will incur to put me on the plane have already been incurred. They've paid for the plane, the fuel, the insurance, the salary and benefits for the crew, the fee for the gate. Everything's been paid for. The only additional cost of having me get on the plane is a soda and some peanuts. So all those costs I described in a prior segment are sunk or fixed costs. With a make versus buy decision, you ignore those. Why? Because you can't change them. So the fact that you pay a lease payment this month and it's a fixed cost does not enter in your decision making whether you're going to make a product or buy it. I use the example of a lease payment from a retail shop. You will consider variable costs, certainly, and you'll also consider, as I said, non-monetary decisions like the quality of the work that comes out based on your decision. And I know that for most of you in this audience that are creative folks, you have a very high expectation of the quality of your work. It's got to be of high quality. Okay? Let me give you an example of a make versus buy. The best example is somebody that's making a product, making a physical product, okay? So let's say you make blue jeans. And you make a line of blue jeans and you'd like to add a line and stick your label on them, okay? So you go to Acme Jean Company and you want to buy their jeans, slap your company's label on them, make a few minor changes and sell them to the general public. You want to add a new line. So you have a choice. You could write a check and simply buy the jeans. Let's say that that cost is $20 a pair. A pair being one unit is a pair of pants. So that's a choice. The other choice is you could make them yourself. You're going to incur material costs like denim and thread. You're going to incur labor costs. Somebody's got to sew the denim and probably run some machinery, okay? If that's $15 a pair, it would seem that it would be cheaper just from a pure economic decision to make the product and not write the check and buy it. Now bear in mind that these costs are variable costs. Variable costs. None of these, in this type of decision, none of these are fixed costs. They're all variable. So if it was $15 a pair, you just go ahead and make them and not buy them. But what if it was $30 a pair for you to do it? You've got to take a long, hard look at whether it's worth it to buy it from the outside vendor. Now, there's a risk, and we've talked about it in the last segment. And the risk is that the quality of the product, in this case the pair of jeans, does not meet your standards. The denim's frayed, the sewing is poor, whatever. It's poorly packaged, it's shipped and product gets wet. There's a dozen things that could go wrong. So even though it may be less expensive for you to buy it, you may have a quality issue and buying it may be a bad idea, okay? So I've picked on Christine told me in the hall I was picking on her today, and I'll continue to pick on her. If she goes out and hires a production assistant, pays them a fee to do a task that she could do on her own, and she could do it better on her own, I mean, now you've got to start having that conversation about, is it worth my time, or should I hire somebody to do it? So under this category of make, maybe the make category would be spending your own time. For those of you who are creative folks and don't necessarily make a physical product, do I spend my own time and essentially do it right? Or am I able to contract out and have somebody else do it and maintain the same level of quality? All right? That's a make versus buy decision. Yeah, Jackie.
I also kind of want to, what is your company's values factor in all that? And I say it's particularly when you're in production, which I am in, and I have the choice between making something that's a high quality or buying it, outsourcing it for the most part, because a lot of things aren't made in the U.S. and the factories that are where they're being made aren't factories that are in what the values of my company are.
Right. That's an issue. My oldest daughter is involved in this, that there is a movement at her school in the area that handles social justice about whether, what they call it, fair trade, whether the product is made there. So there's an ethical decision there too. And we talked about Tom's earlier in the day about, okay, Yeah, there's economics decision about making Tom shoes and how much that costs, but part of the mission of the company is to give shoes away to people who need them, and so part of the mission is charity, and it's not just about money. You're exactly right. Other questions on that? Yeah, Josh.
Factoring in wear and tear on your machinery to make.
Yes. Yes, absolutely. That's a factor here because you're obviously going to use fixed costs to do the business, and you would save wear and tear if you didn't use your machine. Absolutely true. Now, the problem is that can be difficult to quantify. I am going to do something later on special orders that I think will address that, taken on a special order. Other questions? That okay? Next one, sell or process further, which is related. Should you sell your product as it is or add on more costs and try to sell the product for a higher price? Do you sell the product as is or do you add on more cost and sell the product for a higher price? Now, this gets back to a comment that Jackie made where she said, my client has a budget for what they want to do. If they have a budget for what they want to do, it is unlikely that I can add on costs and charge them more. So there's a ceiling on what they're willing to pay. So if what I'm doing hits the ceiling, I really can't process any further, is what I'm getting at. So what information, again, do you need to make the decision? How much more cost is there involved? And we call that incremental cost. So I'm going to write on the board here so you can see it and know what I'm talking about as sell or process further. Incremental cost. How much more cost do I incur if I continue to produce the good? And I'm going to give an example in a minute. The other is, how much more revenue do I get? In other words, can I charge a higher sale price? Okay? So if I go back to my blue jean example, and I make blue jeans for 15 bucks, and I can sell them for 30, but I can add on more cost. I can add rhinestones, and I can add other decals on the jeans, and I can incur more costs, but I can sell them for more money. The question is this. If my cost to move from the blue jeans as they are now to the more fancy jeans is another 10 bucks, but the revenue that I make is an additional 15 bucks, I can charge 15 bucks more per jean. Should I do it? Strictly economically. Yeah, I should because I come out $5 better off. I'm $5 better off. Okay? In your fields, I think sell or process further might work like this. You create a video, you create a product for somebody, and you're probably going to stop. You create a video series to promote a company, and you're going to stop. And you're going to say to the client, I did what you asked me to do, and I stayed within your budget. If you want me to do more, here's how much it'll cost, and here's the sale price. If you want me to do this much more, I need to charge you this. But if you can't afford the higher revenue, I can't incur the additional costs, and we'll just leave it as it is. And you let the client decide that. See what I mean? Anything else on that? That is called sell or process further. Okay? If you remember back to earlier today, and it's also on the bonus material on the formulas, I talked about the break-even formula, which was sales less variable cost less fixed cost. Okay? Let's use that and talk about something called margin of safety. Okay? You can look at this in sales dollars, or you can look at it in terms of units sold. Okay? I'm going to use B/E for break even. Let's say that my break even in sales dollars, sales less variable costs, less fixed costs equals 0, which we've talked about repeatedly, is $100,000. Dollar sign, it's dollars. Let's say that represents 2,000 units. Now I'm going to put the word unit below it so I know this is dollars and this is units, right? That's break even. That's just the point of both dollars and units where I just get all my money back. That's not the goal. The goal is obviously to be profitable. Here's what margin of safety means. I have a profit goal as well. And I can express that profit goal in terms of a certain amount of dollars sold. Remember target net income? Where I took the break-even formula and I put a profit at the end, and I found out if I sold more units, I cover all my costs and I make a profit. So I'll make numbers up and I'll say the sales dollars is 120,000 and I have to sell 2,500 units. Now I want to keep blue. Okay? Margin of safety says, how much of a cushion do I have between the profit goal and break even? In terms of dollars, I have a 120,000 less 100, I have a $20,000 cushion here, 20K. When I budgeted at the beginning of the year, and we've talked about budgeting, I've got a sales goal to reach my profit level, which I don't have on the board, of $120,000 in sales. However, actual never turns out exactly like budgeted. My sales could go as low as $100,000 and I'm still profitable. My sales could go as low as $100,000 and I'm still profitable. When you think margin of safety, think cushion. What's my cushion? Okay? A lot of friends of mine who are self-employed think about there's a certain amount of money that I need to make to cover all my bills, not only for my costs for my business, but all my bills at home, and then anything above that is kind of my gravy, my cushion. It's another way of looking at margin of safety. Okay? Let me look at the slide for a minute. If my sales are less than planned, at what point do I start operating at a loss? I give you a definition. Actual sales, in this case, 120,000, less break-even sales, 100,000. Now, I also put it in terms of units. You may want to look at it in terms of units. Okay? For example, if your cushion is 500 units, and there's 52 weeks in a year, essentially what you're saying is, if I just sell about 10 more units a week than break even, I'm going to make my profit goal. Let me do that again. There's a difference here of 500 units between break even and my profit. So one way of looking at it is, if I just sell 500 divided by about 50 weeks, if I just sell 10 more units a week, I can get from my break even to my profit goal in units. So if you want to look at it in units, you can. If you want to look at it in dollars, you can. Okay? Jackie.
So I have a
question about like the break even and when you're coming up with that number. Would your break even number include the salary that you would pay to yourself, or are you including that in your profit?
Yeah, and that's a great question. I use the example of the guys who started the pizza business, and two of the brothers sold envelopes, and one was a golf pro. My recommendation is that you include in your break-even number as a fixed cost some sort of salary for yourself. Yes. Now, some people don't do that, and they say, I'm going to look at my profit, and I'm going to consider my profit to be my compensation to myself. I think you should build it in, because again, if you build it in and that's a fixed cost, then that profit is really profit, because now you've already paid yourself. Now that's really extra money, so to speak. Okay? Other questions on that?
Can you do that as a corporation as well as sole proprietor? Or?
Sure.
Okay.
You can do these calculations for any type of corporate business formation.
You can pay yourself a salary.
Yep. Now, the tax consequences of that I would talk to a CPA about, because is it W-2 income? You need to talk to a CPA about that. Other questions on that? I'm writing smaller because I'm trying not to use up so much paper here and flip this thing all the time. How much money do you need to make after tax? Now, I have this conversation with people a lot, people who are just talking to me about business or whatever, because I look at income after tax, okay? So here's what I mean. Let's look at the definition. Question: given a rate of tax on income, how much profit do I have to earn to generate the same amount of after-tax income? Given a rate of tax, and I've been having discussions with people here this week. I know California state tax, pretty high tax rate. How much profit do I have to earn to generate the certain amount of after-tax income? In other words, I'm trying to distinguish between your profit and what you actually get to keep. Profit and what you actually have to keep. One of the conversations I had with the producers, he talked about his accountant recommending that he withhold about 40% from his pay, from his 1099 and his freelance income, to pay his taxes, figuring 25%, 30% federal tax rate, 15% state, or 15% state and local, withhold 40%. That conversation about withholding relates to this slide. Okay. Uh-oh, here comes some algebra. I think it's the last algebra of the day that's on a slide. Okay? We've got a fraction in the numerator. At the top, it says on the left, the desired after-tax income. How much is it that you want to make after taxes? In the example I have on the board, the individual wants to make $50,000 after tax. The denominator is 1 minus the tax rate. Now here's a way of thinking about it. I'm going to call this tax impact. If you think about your income as a pie, and 40% goes to taxes, you're only keeping 60%, right? So if you're trying to figure out how am I going to make $50,000, this is the $50,000. This is going away. That's what I'm trying to say. So because there's a chunk of this coming out for taxes, the portion in blue has to be bigger. Because you're not making the whole pie. You're only making 60% of the pie that's in blue. Visually, if that helps you. Okay? So what we're saying is that at a 40% bracket, this individual has to make $83,000 to have $50,000 after tax. I had this conversation with somebody about education. A young family, a guy who has young kids, was talking to me about college. And he was talking about saving and how much does it cost and scholarship and all that. And I said, well, the way you should really look at it is to take the amount of money you think this college is going to cost and divide it by 1 minus the tax rate, because that's how much money you need to earn. Then pay taxes to get the money that you want for college. Okay? That was something he wasn't familiar with. And he was like, oh, okay, now I get it. It's about how much I earn less the taxes. That's what I have in my pocket. All right? Josh, I'm sorry.
Yeah, I was going to ask about this and how it related to contribution to profit, contribution margin, where you...
Yeah. I would keep those concepts separate. Let me write what contribution margin was on the board. Yeah, I would keep those separate. I'm going to put C margin for contribution margin. Which we defined as, oh, there's going to be a quiz at the end. Does anybody know what the number is? I'll give you credit for this question. All right. The only Creative Live instructor that gave a test. We said sales minus variable cost was contribution margin. And then I went on to say, and I can understand why someone might think this relates to that issue. We said whatever's left goes to cover two things. It goes to cover fixed cost. Does anybody remember what the remainder is? Profit. Now, I guess, excuse me, Josh, now that I think about it more, I could relate this to that formula because that profit number is going to have tax subtracted out of it. I think that's what you're getting at. Yes. Yeah, you're right. Yep. Brian or Ben, if we could go to the main slide for the course, what I'm going to do for the rest of the time we have is I'm going to do some stuff on the board here. I'm going to run through some new stuff, and I'm going to wrap up with some old stuff, the most important things in the course that I want to get across to you. Okay? Let's talk about cost of your product. So again, most of you in the audience are doing project-type work. And Jackie mentions that there's a price that the client is budgeted and is willing to pay. Okay? So, and this relates to budgeting. So there's a concept called target costing. So you can start at the top and work your way down, so to speak. So you have a client that's budgeted $50,000 for a project. That's the budget. That's what the client's willing to pay, so that becomes your sale price. You obviously have costs that you're going to incur. And the difference between the cost and the sale price is your profit. So what you're trying to do as a creative person is to manage the costs. And specifically what I mean by that is you need to minimize the costs here while maintaining the quality of your output, right? Of what you produce. Okay? Because, in other words, you can't, Brian, I'm sorry you just sat down, but could I get some water whenever you get a chance? You can't do anything about the top, right? You can't bump up the ceiling. They're not willing to pay anymore. So the only thing you can control to get a decent profit is to control the cost, right? That's the only thing you control. But with creative folks in the audience, you have the additional concern, thank you, is $40,000 in my example going to produce a quality product that you're satisfied with? Now, you know, all of us in business, I think, are willing to spend more time than we plan to get something right? We all do it. So, one way to get out this quality product and still keep your prices down is to, you know, do more of the work on your own that you might hire somebody else to do, which goes to the make versus buy decision. Maybe you think about that. You know, in order to keep the cost of $40,000, I could go out and hire that assistant production person, but I'm going to do it myself. Or I was going to hand off the editing to somebody else, but since the costs have to remain here, I'll use the equipment and do it myself to stay within the budget. Because there could be a payoff. I mean, there's some good news here. And the good news here is that the client comes back and asks you to do business again, and then you make more profit when you come back. All right? And I've done that before. I've done consulting and training where I give somebody the first half hour for free because they email me and tell me, I need 10 hours of help. And I say, well, before you make that big investment, I'm willing to give you the first half hour for free, and you can make a judgment on whether this is effective or not. It's a half hour of my time. It's no big deal. Okay? So there are times when you have a ceiling above which you can't charge. That becomes your sale price. You want a cost that creates the quality product that you want and have a reasonable profit. Now, of course, the other part of the equation is if you really think it costs $45,000, you can cut your profit if you want to do it that way. That's certainly possible too. That's called target costing. Target costing. Questions on that? We talked about inventory, and I've got the notes that I put on the board before the end of the break. Is that big enough for people to see, Brian, if I'm writing like this?
Yeah, it's okay.
I'm just trying not to blow through so much paper. Inventory formula. We've talked about inventory, but what I didn't do yet was to talk about the formula for inventory. Now let's think about a T account again. Inventory is an asset. Okay? But now I'm going to put a finer point on it. Because you have beginning inventory, let's say it's 1,000. You add in your purchases. $500. You sell some stuff. We take it out of inventory and it goes into cost of sales. $300. So it's $1,500 less $300, so my ending inventory is $1,200. Beginning inventory of 1,000 plus my purchases, less my sales, I need to write that down, is my ending inventory. So when you are budgeting, remember when I did the cash flow roll forward? Where I had beginning cash, I had receivables from sales, I had dollars you send out for making your product, and I had an ending balance. This is the same kind of thing. Because if this is January ending inventory, it's February beginning inventory. Okay? Which brings us to a point about how much inventory do you have at the beginning of the month? I'm going to abbreviate begin of month. You want to have enough inventory on hand so that you can meet sales at the beginning of the month, right? You don't want people walking in your store or going to you online when you're out of product and risk losing a sale. So you need to budget for some beginning inventory every month. And yes, that's going to cost some money, and yes, that's going to hurt your cash flow because you got to have some inventory. But you got to have some at the beginning of the month, or else you might risk losing a sale. Okay? Let's go on and talk about relevance. Relevance means that something is important enough for you to pay attention to. Relevance. And my point here is not all this accounting information, not everything in QuickBooks is relevant. Okay? We did that example where we said with make versus buy, with seller process further, if I spend more money incremental cost, do I make more money incremental revenue? Well, if the difference is only 1 cent, you probably wouldn't do it. That's too small an amount to be relevant. So this gets to how much information you need out of QuickBooks or your accounting system or a conversation with your CPA. The cost of the information has to be less than the benefit it produces. The cost of the information has to be less than the benefit it produces. I used to tell my accounting students, accountants are asked to print out and create tons and tons of reports that nobody uses. So I said in a class when I was teaching at St. Louis U, if you're going to print out a report, ask the person who wants the report why they need it. So the next class, a girl came up to me who was working at a securities firm in St. Louis as a part-time job. As a part-time accountant. And so she was asked to print out a report from the CEO. And she turns around to the CEO and goes, well, do you really need that report? And he got mad at her. And then she came to class and got mad at me. So we are all asked to create as accountants lots of stuff that nobody uses. In your case, don't waste your time pulling data out of QuickBooks you don't use. Because remember that QuickBooks is a black hole of information. You want to print reports? You can spend all day printing reports in QuickBooks. Don't print stuff that you don't need. So what do you need? Well, I think you certainly need your income, your profit and loss. I'm going to get back to QuickBooks one more time. I'm not going to do it now, but later. You need your profit and loss, for sure. I think you need to look at your cash. Look at your cash balance and make sure that's reconciled. So I'd spend time on that cash section. And finally, thank you, Ben. And finally, or Brian, you got to look at your balance sheet. So income statement, cash, reconciliation, balance sheet. All right? Those three you certainly should look at. Now, we've talked about throughout this course that you may want canned reports or special reports in addition to that, and that's fine. But be clear, and this is where you need to talk to an accountant and think about your business on exactly what you need to do what you need to do and set the rest of it aside. Let's not waste time on it, all right? Let me do product life cycle. I'm going to go to another page. That's too low. Those of you in creative fields, you use heavy technology, many of you, and you find out that that technology gets out of date quickly. And that technology generally as a business can get out of date quickly, right? So there's this thing called a product life cycle, and this may relate to your business. I know many of people out there are photographers, and we have the conversation that some people still have dark rooms to develop film, but that's a technology that's going away. So just consider this for your business. So you start a business, or think about a product generally. A product starts, it has a growth phase, and then in economics, when things kind of level out, Facebook's a good example where Facebook use is kind of leveling out. It's called a mature business. And then eventually, a business may go into decline. Now, why do I bring all this up? A couple reasons. You need to consider the business that you're doing or trying to do and where you fall on this line. Okay? If you were doing a photography business where you specifically use a dark room to develop, you may think that's great and unique, but if the market doesn't see that as valuable, that's a business that may decline. So what I'm suggesting is that you think about where you are on this line. Now, some businesses really don't change much, okay? People need roofs on their houses and need their plumbing fixed. Well, that's an industry that really doesn't fit this trend. I'm talking about most other industries where things start, there's a growth. Online education is a great example. We've had explosive growth in online education. But lots of businesses flatten out where it matures and the demand flattens out. Facebook may be a good example. Another one is viewership of major sports, baseball, football, basketball, and attendance. The attendance is flattened out. And the reason that attendance is flattened out is with all these huge TVs and great technology, more and more people would rather just watch at home. So attendance at major sporting events is flattening out. So they need to change, right? So I'd like you just to consider where you are on this product life cycle. Okay? What I'm going to do, just to make sure I don't forget, I want to go back and I want to just buzz through some of the things we've done on QuickBooks, and then I'm going to finish up the course with a little bit of new material and some review, because what I'm trying to do is to tie this all together. So if we could go to the QuickBooks screen, please. Let's just buzz through this and just try to solidify in your mind, where things are is really what I'm getting at. Okay? So remember, if you go to the wheel, you can set up your company here in company settings. We reconciled our bank account over here. We found out that if you want budgeting, you can add that on. That's an add-on. So those are the main things that we covered that is under what I call the wheel right there. This one shows you recent transactions, which I think is a great tool because it kind of helps you remember, well, did I do that transaction? So for example, that check we wrote, or that bank service charge is here. That got posted as a check, and it was a service charge that we were charged by the bank when we did our reconciliation, and we see that the service charge is on the bank statement. We did a service charge. So you've got recent transactions. There's two places where you will probably spend most of your time, either on the vertical page here or on the plus here. And you've got some choices as we found out. You can go to customers here, or you can go to customers over here. Vendors here, employees on the side. You see how this flows. So you're probably going to spend most of your time on the X, which is the create. And remember that when you open it for the first time, it's going to show this, and you can expand it. We created invoices. We created an estimate. We wrote checks, we had expenses, and we created some payables. And again, this was the screen, the create screen where I did journal entries. Also note, because I didn't do one, this is where you can make a bank deposit. And again, where you can make a bank deposit is the create over here under other. So I think you're going to spend a lot of time here. Now don't forget in the middle, because I don't want to neglect it, you've got some great stuff here in the middle of the page. I think this is the best improvement that QuickBooks Online has done. You got income here. Open invoices, meaning those people that you've billed, they haven't paid yet. Overdue, people that owe you, that you consider late. If you click on that, you see that nobody's overdue, and you see how this red box goes up a little bit. That would occur when, on the invoice, when it says it's due in 30 days, if it's the 31st day, that invoice amount open is going to move to overdue. Nobody's overdue right now. And finally, paid in the last 30 days. Expenses, super cool. You can see how it gives you different shades of blue. I know for you creative people, this isn't the most creative. This is not, the Mona Lisa. But it's kind of cool how they give you different colors and they tell you the categories of where those came from. That's kind of cool. And it also says how much you've spent, how much you've expensed in the last 30 days. And finally, at the bottom, profit and loss. And let me remind everybody that the income statement in accounting world is what profit and loss is in QuickBooks world. So don't forget that there's some valuable information here just in the center. Now this activities down the right here, you may or may not think that's useful. It gives some information, historical information. I personally haven't decided whether I like this or not. It does show all these transactions. If that helps you, great. A jury's out with me on whether that's helpful. Okay, left-hand side, transactions. Here's our banking. This would be if you were going to bring in, download transactions, which I would highly recommend from your bank. You do that here. Sales, we created invoices from here. We also created an estimate from here. You'll see at the bottom that we had invoices, estimates in the same place, and it also told us when an estimate became an invoice, we closed the estimate and the invoice was created. Open invoices are those where people owe us money. That yellow box, open invoices, relates excuse me, to these down here. Paid invoices in red agree to this area up here. I just think this is eye-catching. It's not Michelangelo, but it's just eye-catching for me. Expenses, expense transactions, listed here. What I'm hoping is that if you're out there watching that, again, if you've got this course in front of you and you can watch the video and then minimize my video and go click around and then go back to the video, that this is going to start to sink in. That's what I'm trying to get across. Reports. Again, let's not use reports that aren't meaningful. I think the balance sheet you definitely need. Remember that. The groupings, that we have assets, liabilities, and equity here. They're always in that order. Remember that you can click on any of these numbers and get the detail. So there's all the cash detail. Not surprisingly, we had more cash transactions than any other account. That's the way it is for most businesses. Maybe 40% of the transactions you'll post affect cash in or out. So again, reports, balance sheet. You can click on any of the numbers and get the detail. And also remember that when you click on a number, you get all the transactions for that number. Let's click on accounts receivable. You get all the numbers for accounts receivable. Okay? If it's 2 or 200, you're going to get all the numbers. So that's balance sheet. Go to profit and loss. Income, expenses. There's your net income. That's what your accountant's going to need if you ran this report for the whole year. This course is going to end exactly when I completely lose my voice. That's pretty good timing. I'm going to sound like Froggy from the Little Rascals at precisely the end of this course. It's going to be great. I timed it perfectly. I'm a professional. Don't try this at home. Okay? Now, here's what I'd like to do, Brian or Ben. If I could go to the PowerPoint slides, please. The slide deck. I'm going to let you guys can do it faster than me. Thank you. And if you could leave that up, that slider up on the side, if you could put that back up there. Can I have the slider up on the side? The scroll button. Thank you. Thank you. All right. There we go. I am going to try to tie a bunch of stuff together, and the most effective way to do it is on the slides. Okay? I'm not going to go through all the slides. I'm going to click on some of them. So if we could go ahead and go up, and I know it's not ideal. I'm going to leave this here just because I'm going to go through these. And it's not full screen, and it doesn't look as professional, but it's an effective way to do it, okay? Way back in the Wayback Machine. I'm not going to hit on all the slides. But I am going to hit important points that I really wanted you to get out of class. If I have time, I'm going to do some more stuff here, but I'm just going to play it by ear and see what happens. The way I opened the course was, I know we're excited about when we get new business, okay? We're excited about it. But don't let organization fall to the side at the very beginning. Because we've seen throughout this course the negative effects of not getting yourself organized when your business gets busy. So we go from excitement to the need to organize. I know it's boring. I know you're not making any money organizing yourself. You're not making any money learning QuickBooks necessarily. But that was my opening sort of grabber, if you will. I highly recommend, if you haven't done it, that you go online and take a 100 question Myers-Briggs for free and find out your strengths and your weaknesses, which relates to who you need to go out and get to help you with this business. Maybe you don't need anybody. Maybe you have the self-discipline to do this all by yourself. I don't know. You could. Okay? Because the real challenge is you can do 2 orders a month and be disorganized, but can you do 200 orders a month? Can you answer 20 emails a day rather than 2? You know what I'm saying. Things accumulate. Paper, emails, texts with clients, photos, your product, not only that you give to a client, but that you have to file and store, your bank transactions, your bank statements, the QuickBooks records yourself, which I would urge you to print off in spite of backing it up online on the cloud. So my goal is to keep the paperwork from piling up. I'm going to go through these questions because I think they were good. And Justin, my producer, helped me write these questions, and we threw these in at the last minute. And I thought they was a great idea. What are your markers for measuring success for your business? Now, we've brought up today, Jackie brought up, your goal may not be completely, and I would suspect it's not for most people in creative field, just making lots of money. You want to, you have a mission. It's not just about money. It's about creating a good product. It's about helping people. It's about doing something for your community. It's about social justice, on and on and on. So your success may not be just all monetary. One more time. This seemed like we did this 100 years ago, doesn't it? Assets minus liabilities equals equity, and it always stays in balance. And this was the starting point for talking about that whole debit credit discussion and talking about posting activity. Assets are stuff you use in your business, like the pizza parlor uses, the ovens and the tables and the chairs. And there's two groups of people that have a claim on those assets. People that you owe money to for the accounts payable or the bank loan is a liability. All owners are the other people that have a claim on some of those assets. So liabilities are money that you owe somebody, the payable, the bank loan. Equity, my best definition, if you sell all your assets in the pizzeria, the oven and the furniture and the building, and you got a pile of money, and you take the pile of money and you pay off all your liabilities, the accounts payable and the bank loan, and you got a pile of money left, that is equity. Ownership. Equity means ownership. Now, I also mentioned that that is sometimes referred to as book value. That does not exactly match up with accounting definitions, but you may hear the term book value, which is fine. I'm okay with that. Revenue or sales, again, those terms are used interchangeably. Please don't be confused. Your company generates less your expenses is your net income or profit. Net income and profit are the same. Revenue and sales are the same. One of the top 5 most important things from the course is the accrual method. Okay? Matching the revenue you create with the expenses you incur for that, regardless of when the cash moves. This relates to the whole cash discussion earlier today, where I said, if you're going to do more business in February, you're going to have more cost in February. If you do even more business in March, you get even more costs in March. They relate. They relate. Don't forget about the cost for doing a whole bunch more business. Again, why? Who cares? The only way to truly match sale in one period with the related expense in another period. I use the example of the photographer who flies to New Zealand to take pictures in July may not even have a customer to sell it to. But they think the pictures are going to be of such high quality that somebody will buy it. Okay? The reason you spent money in July is so eventually you'd sell the pictures. It so happens you sell them in December. I promise it's the last time you'll ever have to hear me talk about double entry accounting. It's a promise. Each entry has 2 sides. I like T accounts because they visually explain the process. When you buy the video, rewind it, and go to those times when I did T accounts on the flip chart. Pause it, go to QuickBooks, make an entry, debit and credit. Okay, that makes sense. Watch the video. What was going on there? Oh yeah. Go into QuickBooks, debit and credit. You can post your entry. Even when I die, debits and credits are always on the left. Debits are on the left, credits are on the right. And remember that everything's in balance. When I was in QuickBooks, several times I mentioned, if you look at the bottom of a journal entry, the QuickBooks system forces you to have debits equal credits. They have to equal. They have to equal. Whoops. Sorry. Again, I like the questions that we created. What is your impression of QuickBooks? I hope you got a little more comfortable with QuickBooks, and specifically, the reason I went through that review was if you can just open QuickBooks and have some sort of feel for where things happen. And there's the challenge that you can do a lot of stuff on the left side column that you can also do by hitting that X create drop down on the top. So the left column matches a lot of stuff you can do on the create drop down. And I get that, and that causes confusion. But I hope that you got a little more comfortable, and the way I hope that you got a little more comfortable was I did the accounting, debit, and credit stuff on here and on here, then I went to QuickBooks. Because if you didn't have that basis, it wouldn't have worked. Because the first time I would have started doing debit and credit, you're like, wait, what? Huh? What? You got to explain it over here first. How does your current profit compare with others in your industry or your creative field? I know it may seem like a bit of a distraction or, excuse me, something that's time consuming and not necessarily money making, but take a look at others in your field. And it's an effort for me to try to read and stay on top of things. I look at Entrepreneur Magazine online, for example. I try to look at it. I try to read other marketing emails I get from HubSpot. I don't always get to it, but try to make that effort to find out more about your field. Okay? Profit margin. This is an easy one to remember and think about. For every dollar you sell, how much profit does it generate? For every dollar you sell, how much profit does it generate? And for example, this is a 15% profit margin. You sell it for $300, you profit $45. It's 15%. Is that good? Depends on your industry. Depends on your industry. When should my business become profitable? Well, for many of you in creative, we talked about, you've got low costs, it's project-based. So when you get the order to do the first project, Jackie mentioned that I don't even carry any inventory. That first order might be profitable because you have very low fixed costs, if any. But for a larger business, you may have startup costs that require you to operate at a loss for a period of time. And we had a conversation, I don't remember if it was on camera, I think it was, where there are, you need to talk to your accountant about the issue of being in a business and losing money for a year or two and how that's perceived from a tax standpoint, and I'm going to leave that for an accountant to talk about. Start a restaurant, for example, you're going to lease the space, the build out to change the physical design of the building, advertising costs, furniture and equipment. If it totals $200,000, how long would it take you to earn back that $200,000? Or in other words, to recover your cost? Well, you'd have to do $2 million in sales at a 10% margin, 10 cents. You'd have to do $2 million in sales at a 10% profit to earn back the $200,000. Much of the $200,000, though, if you look at the bottom, the last sentence, represents assets invested in the business, and they're not immediately expensed. So the oven and the build-out, those are assets you used and that are going to help you make money over the long term, so you don't expense them. You don't expense them. The catering example was about a particular client being profitable. We talked about the idea of some clients you want to do business with even if they pay you late, even if they're maybe a little demanding. This was the example of you got a catering business, you have a set menu, you charge people $50, you charge a client $50 a person, $30 cost of food, $10 for the staff and the travel. It's a $10 profit. It's a fixed menu. However, two of your clients don't play well with others. They don't behave. Labor, one client says, I want everybody to stay and clean my house. And you say, well, wait a minute. Our understanding is that we wipe down the tables and put away stuff and we leave. Okay? The client expects you to stay longer. Your people stay because they don't know what to say. And you end up paying more labor costs for your catering staff to clean their house. That was not the deal. Unaccounted guests. You expect 20 people to show up, 30 people show up. You've got to get more materials, cook more food, run back to the house with it. And oh, by the way, because you had to buy all this food at the last minute to cook, you probably paid more than you otherwise would, right? So the solution to this, how to resolve it, is to explain this to them in advance. Hand them a document that says, here's what we do, and explain it to them. We're happy to wipe down your tables and pack up everything and leave. If we spill something, we'll clean it up, but otherwise, that's all we're doing. That's all we're going to do. Another question we talked about was business formation. How would you structure your business if you brought in a partner? And we went on to the slide that mentioned sole proprietorship, partnership, and corporation. Remember that sole proprietorship and partnership, the taxes flow straight through to the owners, while corporation is taxed at two levels. That corporation files a tax return and pays tax. Then they can pay a dividend to shareholders. That's also taxed. So the corporation has double taxation. Please consult with an attorney about the legal liability of being in one of these forms or another. And we had a conversation that Candace brought up about getting, liability insurance for yourself to protect yourself. Secretary of States have made it pretty easy now to form a business in a state and pick a fictitious name. Taxes flow straight through. The partnership, again, is defined as two or more people, could be thousands. And that the partnership agreement for most states can say whatever you want it to say. Whatever you want it to say. Specifically, the share of ownership as a percentage can be different from the share of profit and loss. So you can have somebody with a lot of assets who puts in 90% of the money and owns 90%, and another person who only owns 10%, but they work in the business every day and in exchange get more of the profit. So the owner sits back and his attitude is, I've put in and I own a lot of this company and I'm willing to just, get some income from this business, but I don't have to work in it. General partners, bottom right, have unlimited liability for the actions of other partners. Very, very important. And I mentioned several situations where, classic case, one partner is the guy who's doing the business. He's out there presenting the product, billing clients, finding business, and the other partner is the guy who's doing everything else in the office. And one person can make big mistakes and not communicate it to the other person and put the company at risk. Maybe the guy who's out selling really drops the ball and doesn't deliver a product or service to a client and they're harmed by it. Maybe the guy in the office completely botches the accounting records and you get an audit, okay? You got to communicate with each other and be clear in a partnership agreement who does what, who's responsible for what, how are we going to hold each other accountable. Partnership. If you eventually want to grow a big business, I mentioned that corporation is the easiest way to raise capital because you can just about raise as much money as you can get investors for with a corporation because you can just about issue as much stock as you want to with a corporation. But you have the disadvantage, top right, of taxation. If you imagine that bucket again, the profit goes into the bucket, the corporation files a tax return and pays tax on it, and then they cut a hole in the bucket and they pay a dividend to a shareholder, and that's taxable to the shareholder. It's taxed twice, in the corporate bucket and in the individual bucket as a dividend. So I have bottom right, dividends taxable as shareholders. So that was our conversation about business formation. What are the challenges with keeping your personal and business activities separate? I tried to set up the business formation discussion first to help me make the case as to why you needed to keep business and personal records separate. And again, from the very first slides of the course, don't get off track by keeping business and personal together. Separate it tomorrow. Get that taken care of. Get the bank account set up for the business tomorrow. Separate the records tomorrow, please. Why the need to separate? There's a tax issue. Again, I've talked to people while I've been here at Creative Live where they need to get their taxes done, and now you've got to kind of think about, well, where are all the records and how did I record them, etc. It's kind of a scramble. There is legal liability. You need to check with an attorney about this whole, if you commingle your personal and business records, you may be considered that you and the business are the same thing, and your personal assets are at risk for liability. Another reason to go out and get insurance, talk to an insurance agent. Well, the better reason to separate your records is to look professional, okay? If you have a potential investor, if you want to take out a loan and a commercial banker or some type of finance company wants to see your records, if you want to take on a business partner, you want to be professional, that includes having separate business and personal records. It's the step, it's a hassle, but it's the step you have to make for long-term business planning. Another theme of this course is, I'm asking you to do all this work not for tomorrow, but for 5 years down the road. When things have gotten complicated and busy and you have employees and you have a lot of activity going on and you say to yourself, I'm glad I set this thing up when I did. Not whether it's me or somebody else getting you there. Set this stuff up now, please. Okay? All right. Segregation of duties, which I explained, I think was the second or third most important thing in the course. The duties that we separate. Custody over the assets. Who has the checkbook? You can have an assistant have the checkbook in their drawer. You can have the assistant have the keys to the equipment closet where you keep all the film equipment. That's okay, as long as, number two, you're careful with who has authority to sign a check and who has authority to access your equipment. And the last one is who can record transactions. And this becomes an issue when you hire an employee, particularly when you hire that first employee. I can't tell you the number of times this has run off the rails. We talked about fictitious employee. I won't go through the whole thing again, but again, to prevent theft, you need to control the billing process. You need to send out the invoice. You need to account to where all the invoices are. You need to check those deposits coming in, as we did in QuickBooks earlier today, and match that deposit with the invoice. Which invoice are they paying? You need to do that. You need to always reconcile your bank account. And for goodness sakes, don't ever let an accountant have authority to sign a check. That's a big no-no. I've told clients that many times. Could you just do this? And I'm like, no, you don't want me signing checks. Bad idea. So you're going to control the invoicing, and you're going to control the accounting process. The accounting process. T accounts we already covered. Posting entries we've covered for the most part. I am going to make that distinction again between capital accounts, which is for sole proprietor and partnership. I say at the top here, sole proprietor and partnership equity equals the sum of all the capital accounts. So if it's Mo, Larry, and Curly as the partners, Mo's capital, Larry's capital, etc., the sum of those capital accounts is the equity or ownership in the business. That's for a sole proprietorship or partnership. Okay? Those accounts get increased when those partners, when those sole proprietors or partner put money in the business, either cash or equipment. It's reduced when they take money out. It's on the screen there. increased by capital contributions and profits, decreased by payments to owners and losses. This is the number one thing that accounting friends of ours deal with at tax time, is figuring out what the capital account balance is, because now everybody's scrambling through the checkbook. Wait, I think I wrote a check and I can't remember. Well, then I took money out, but let me find that check. And nobody knows where this stands at tax time. You got to keep this straight. Got to keep this straight. I'm going to skip through that. I highly recommend that you get somebody else to do payroll. It's not very expensive, even if you just have a few employees. For the reasons that are listed in this slide, there's a lot to do with payroll. You got to calculate the deductions. You got forms to fill out. You've got deposits to make. Jackie and Owen and I talked about, well, what if I want to know the total I've contributed to 401k or the total insurance premiums I've paid out of my pocket as the employer? And I suggested that look at your vendor statement. So go to the investment company's statement to get the 401k total. Go to your insurance company's statement to look at the benefits you paid. It gets a little tricky to look at the payroll company's statements because they're long and they're hard to read. What's your biggest cost you'll incur in the next 12 months? I think Josh and I kind of had a discussion about that, about machinery. I can't remember. Something about, I think we may have talked about machinery. How do you plan for that cost? How do you plan for that cost? How are you going to use that thing that you buy, that new film camera, to make money? How long will that film camera be useful to you? Remember the difference between current and long-term? We essentially said that a current asset or liability is something that you use up. It's going to be converted to cash within a year if it's an asset. It's going to be paid in cash if it's a current liability. Long-term asset you're going to use for more than a year, maybe the camera. Long-term debt is that bank loan. So if you look in QuickBooks, there's a distinction between current and long-term. Matching principle, so important. I know I've beat on it here pretty good. Prepaid insurance was an example of an asset because if you pay the premium in advance, that's money you don't have to pay later, and we said that's an asset. The bottom of the screen. We talked about unearned revenue or customer deposit. We talked about it again when we did cash today. In QuickBooks, it's a liability account because if you don't deliver the product or service, the deposit's owed to the customer. Think about a magazine subscription where you pay for a whole year in advance. Until they start sending you the magazines, that's unearned revenue because they owe you the money back. Have you ever turned business away and why? And we've talked about this at length. Break-even formula one last time. Sales less variable costs less fixed costs. You set the profit, the right-hand side of the equal sign, to 0 because step 1 in business is cover all your costs. Remember that fixed costs do not change. Yes, Josh, I'm sorry.
Shouldn't you factor in taxes in this?
When we do that, we normally factor it into the profit. So let me go to target net income. So the way to figure in taxes is to make the profit large enough so you get the profit that you want after taxes.
I see.
So this number would be higher. That's a really good question. So target net income took the break-even formula and we added in a profit, and we can make that profit number higher if we want to look at it after tax. That's a good question. There's some math. You guys can go back and look at it. The dazzling algebra that I did. My fingers never left my hand while I did that. Did you notice that? Never. I did not pull a rabbit out of my hat while I was here. I probably should have done that. We're trying to leverage our fixed assets. We're trying to use the fixed asset and get the most we can out of it. If I own a film camera, I want to do as many jobs as I can. If I'm driving the plumbing truck, I want to fix as many people plumbing as I can. I told you about when my transmission fell out of my old car on the side of the highway, and the AAA guy came, he said those guys are using those AAA trucks 300,000 miles driving those trucks. They're getting a lot of income out of one asset. That's a lot of miles. I have a lot of miles on me, incidentally. How much cash do you need to run your business? Besides segregation of duties, maybe the second most important thing I talked about. Invoice your clients, make payment easy, use electronic, bill your client when you deliver the product or service, don't wait. Reconcile your checking account within 5 days of getting the bank statement. Be cautious, point number 3, of adding clients that don't pay you on a timely basis. Consider asking for a deposit so they have some skin in the game to see if they're going to pay you. Carefully consider how you use your cash if you're going to go into a new area of business you don't understand or know about fully. And consider, well, you know, if I really get held up and I get a lot of money that I'm owed and I'm slowed up, how does that affect the other business that I'm in? Okay? So I wanted to mention that. I'm going to just buzz through here really quickly. Because if we're going to get done with this course by Sunday, we better hurry. I've said that in teaching situations. People just go, "What? I'm not staying here till then." Okay. Will new clients pay me quickly? Critically important. Make that training manual for your staff, please. Write it down. Please do that. Not only so you can figure out if that's your secret sauce, so you can improve your procedures. That might be your secret sauce. And if we can go to the home screen, please, Brian or Ben. I want to thank particularly my live audience here for sitting here and listening to me ramble on for what seems like an eternity, I'm sure. I want to thank everybody for watching online, and remember that the point of this course, what I was trying to get across is that there's lots of people out there that have an incredibly creative ability, and I'm just trying to give you enough accounting to make you dangerous. I'm not trying to make you an expert. Please ask for help, whether it's a CPA. Go to the QuickBooks Pro Advisor site. It's a great site. Go on YouTube. People find me on YouTube. Go to YouTube and Google if you have a question on QuickBooks. You don't even try that first, and then if you don't find your answer, go to the Pro Advisor site. Any questions?
I think we covered everything, Ken. I think you wrapped it up and did a great review there. So it is about time to end after 3 days. It's blown by. We've covered a lot of information. I do want to let everybody know, if you have been watching this course and you'd like to leave a review for it, there is an option on the course page for this course to leave your review of Ken's course. We'd really appreciate that. Also, you can still leave your Facebook thank you notes on the Facebook page. Those will be up for a few more hours as well if you have anything you want to share. But I do want to have a thank you to all of you out there who've been watching over the past few days. We couldn't have done this without you in the chat rooms. We really appreciate it. Thank you to all of our students here in the audience. You've been a big part of the last 3 days. Thanks, of course, to everyone behind the scenes who've helped make this happen. Thank you to Evie, who had to duck out. Hope you're feeling better. Thank you to Mrs. Boyd, of course, for joining us as well. And the biggest thanks is to Ken. This has been a great couple of days. So let's give a round of applause to Ken Boyd.
Thank you. It was fun.
All right. So before we do head out, I do want to read a few more of these comments that we've been seeing in the Facebook thank you page. This one is from Liz Crane, and she says, when Ken said at the end of yesterday that all of this accounting stuff is going to help us make better decisions, it clicked completely for me. It moved the subject from black and white to living, meaningful color. It's been an amazing 3 days here, and the examples, stories, and humor were most welcome. Thank you, Ken. And it's true that the goal of Ken's course here has been to help you make better decisions for your business. I know Ken had mentioned before that a lot of these decisions, they may not pay off today or tomorrow. These are for laying the foundation for your business, as he said, over the next couple of years. So this is not something you may see a benefit for right away, but it's important to set it up now, to have this all set up so your business will be ready for when the time comes and you grow. I know we've seen a lot of people in the chat rooms mentioning that this has been great information for them. A lot of people have been bouncing in and out of the chat rooms over the past 3 days. Yesterday, we were even joking about skipping work so people could tune in to watch this course. I know a lot of you out there are busy running your own businesses and may have missed portions of Ken's course. And that's the beauty of being able to purchase the course so you can refer back to it, to see it at your own leisure, and you can get all the information that's relevant to your business. As Ken said, some of this may not be relevant to everyone. QuickBooks is very deep. There are a lot of features in there. So when you purchase the course, you will be able to go through, pause, rewind, and see exactly what's relevant for your business. And Ken mentioned the perfect workflow would be to have QuickBooks open as you're watching this course, pausing it, doing your actions in QuickBooks, and then restarting the video to see exactly what Ken did next. So that's a great way to use this course. And you will also have access to the bonus materials if you purchase this course. Just to recap those, you will have access to Ken's list of book recommendations. If you want to learn a bit more about QuickBooks or starting businesses in general, you can read more based on stuff that Ken has already read himself and has already vouched for and recommends to you. Also, all of the formulas that we've mentioned will be in one easy-to-read place in the formula sheet, which will come in handy, and you can use that along with the video while you're in QuickBooks. And don't forget that you can have access to all the slides that we've had here. Anything you missed, you can watch it whenever you need to help you get through and save your business. So for $149, all of that material is available for you to purchase, but if you do buy it now, as we are wrapping up, you can still get that special $99 live price, which is a fantastic deal. So I want to thank everyone for watching, and don't forget there are 2 more days for you guys to vote for Creative Live as the best education startup on the Crunchies. So we're going to have the URL on the screen. We really do appreciate your vote over the next 2 days. It's a great way to show your support for Creative Live. And we thank you for sticking with us for 3 days. It's been wonderful, and we will see you next time. That's a wrap.